Good morning, everyone. Appreciate everyone joining us this morning. We have an early start today, so thanks for getting up a few minutes early and being here with us. We have a lot of observers today. The Technical Issues Committee is here, so welcome, guys. We also have one of our FAF trustees in the back. David Lillard is here, so thank you for being here as well. And I would also like to welcome our new second chair to the PCC, Demi Fritz. Y'all probably seen her email, so now you get to put a face with the name. And Rebecca's moved up to first chair, so yay. And we look forward to a nice, productive meeting. I guess the other thing to just make sure that everybody is aware, this will be Rick's last meeting with us. He is going to move on and do something else with his career. So we wish him well and have really enjoyed working with him. But Jennifer Weiss has decided to take the role, and we're very pleased with that. So we look forward to working with Jennifer in the future and on all of our projects and our future meetings. And so we will not miss a beat. So, so with that, let's go ahead and get started. The first item that we have on our agenda is the Town Hall update, and I'm going to flip that to Rick.
Great, thanks, Candy. So, I guess first I'll talk about what we have coming up, and then I will talk about what we've just completed. In the fall, our intentions are to meet with the RMA. They have expressed interest. We're still trying to finalize a date with them, so we'll be working with them to try to get that nailed down. We also are confirmed to go to the California State Society's A&A conference, which is on October 24th, and present will be from the board will be Sue Cosper, and then from the staff will be Jeff, and then from the PCC will be Jeremy and David Lomax. And we have just about a month ago met with both the AAA, which is the academic conference, and we met with the NVCA, which is the National Venture Capital Association. And the both conferences went very well. The AAA conference, there was a group of about 38 people, and obviously they were all academics. The intention there was really to share the history and the purpose of the PCC and the importance of private company accounting, and to try to promote the focus of private company accounting within the curriculums. So that was a very good workshop. And then we met later that day with the NVCA, it was a relatively small group that we met with. There were 8 members of the NVCA, as well as a couple members from public accounting. And the NVCA members that were present represented various stages of venture startups from early to late stage. And the focus of those companies that they invest in were primarily technology. When we were there were 5 main areas of discussion. The first and the largest was share-based payments. That was a little bit more than half the conversation. And then we spoke about revenue, leases, and credit losses as the big 3 standards that have been released. And then we spoke about another category, which the topics there included capitalized software and financial performance reporting. That was a open discussion, but those were the items that were brought up by them, and I'll get into those shortly. So with share-based payments, and I'll ask the other members that were present at that meeting to jump in when I'm finished if they have anything else to add, but I'm just going to highlight some of the real key things. That the participants indicated that the nature of share-based compensation depends on what stage the company is in, as well as the level of employee. The participants noted that management incentive units, which are very similar to profits interests, are increasingly common, especially for senior executives. They noted that absent the current accounting requirements, that they would rely on whatever valuation they do for 409A purposes. And they stressed that they weren't that expensive. They were somewhere between $2,000 and $5,000 on average. The participants also said that if the companies were near the IPO stage, that they likely would not elect to do any expedient because of concerns about subsequent restatements when they went public. And there were mixed views about the extent to which the expedient for just private companies would be enacted at all, because of either them ultimately going public and having to restate, or being acquired by a public company and therefore having to align the type of accounting that they do. In the revenue area, what was raised in the revenue section was that they actually expressed support for what is being proposed for the 2-year increments of effective dates between public and non-public for certain types of standards. And they stressed that the private companies learn from what the public companies do, so they thought that having 2 years would be very helpful for them. In the lease area, there was not anyone that's implemented leases. I should say there was one company that implemented leases. No one else had that was present. They said that that the leases don't tend to be voluminous or complicated. And part of that's due to, I think, the size companies and the extent of leases that they get involved with because of the size of the companies. Within credit losses, they did not think the new standard was going to result in significant changes for them because they thought that they already had many aspects of the requirement already in place. And then in the other area, with software capitalization, the area there that was stressed was the term technological feasibility. Within the cloud computing standard, understanding what that cutoff is obviously very important, because if it's before you reach technological feasibility, then you're going to be expensing, but if it's after, then you're going to be capitalizing. And knowing what that cutoff is was an area that they thought could be clarified within the COD. And then for FPR, financial performance reporting, the first statement that was made was that they would like to see a definition of cost of goods sold and SG&A. And when I had explained that that wasn't currently the scope of the project, and I explained what our current scope was, they further stressed that the important thing for them is to try to get some consistency between companies and what goes into cost of goods sold and SG&A, because they think that there's some inconsistency right now. And they had agreed that if you get to greater transparency, that through greater transparency, it would give them enough information that might accomplish what they were hoping for by having a definition. So with that, I'll ask if any of the other members present or any of the staff or PCC members present want to have any other comments.
Rick, the only other thing I'd add, and this has to do with those trend line things we were talking about with types of share-based payment awards, and that is that we were hearing, even among this group, that there is a continued trend away from traditional stock options, which are still out there, still, pretty voluminous, but towards restricted stock units, especially among larger companies.
Well, I just had a question on the AAA meeting, so I can wait until everybody gives their input on the NVCA meeting.
I had a question on the technological feasibility. Was it something to do with specifically as relates to cloud computing, or was it they've never known how to apply the technological feasibility criterion?
Good question, Russ. It wasn't limited to cloud computing. They're just saying in general it's an area where there's some, maybe I can describe as tension between the programmers and the accountants trying to figure out exactly where that cutoff is for accounting purposes. And they're saying that they constantly struggle. And we're hearing that from several of the participants where they're just, it's an area of difficulty trying to apply GAAP and operationalize it.
So as I recall, technological feasibility related to if you were selling the software, but if you were a consumer of the software, it's a different. So that's why I was surprised with cloud computing. I had thought that if you were a consumer of cloud computing, it wasn't as relevant as if you were the person providing the cloud computing service. So were these people buying the cloud computing?
No,
or
they were all
the-
providers.
They're providers,
Providers,
okay.
yeah.
Right.
And it's not a service, it's a selling of software?
Yeah, I think that was leasing software, wasn't it, that they were developing? One of them?
That was just in general. I don't think they limited it to any specific area of software. They're just
Right.
saying in general, it's one of the areas that they continually struggle with trying to apply.
Yeah, but that's the one I recall, the discussion being with respect to.
Anything else before we get to Rick's question on the AAA? Rick?
On the AAA, and Rick, or those who participated, what was the flavor of the meeting? I mean, one of the goals, I think, at least I was hoping, is that, there'd be some good interaction. I hope there was some good participation from those folks. Were they generally aware of what the PCC does? I know we were hoping that we'd get some great feedback from them that, yes, we understand what you do, we build it into our curriculum, all those type of things, and I guess what was the flavor of the discussion?
So a couple things. First of all, what was interesting, to your point, yes, part of the reason was to inform people that there's even something to be informed about. And it was funny that one of the first participants, as we were starting to gather up, said, I came to this thing because I didn't even know that there was something to know in the first place. So it's an unknown to many of them. And I took an informal poll, and I asked, how many people have heard the PCC? What, about half of the room maybe raised their hands, I'm thinking.
That's about right.
So there's not a great awareness, I don't think, of the PCC. And I mentioned to Candy yesterday, too, that I think one of the things that maybe FASB could do is maybe prep a 1 or 2 page kind of, I think like textbooks or something need a call-out box or something to at least inform students and others that there are things that need to be students and faculty need to be aware of about what the private council is doing. And so I think there are things that we can kind of keep working on to do that. But it is interesting that one of the reasons, the motivations for doing it is I don't think a lot of people even know that they need to be informed. So hopefully that was, and I think that it started to achieve that. Now, we had 38 people out of the thousands that actually at this conference, so it's a start.
But to be fair there, Mike, there were, 43 consecutive, concurrent sessions at the time?
Exactly. And even though Christine was on there, we still,
And Mary Barth.
and Mary, yes.
Yeah, I think to Michael's point, if you look at many textbooks, they will highlight where there are differences between international standards and U.S. GAAP, but they don't do the same for private company differences, and so I think that's something that would help. But raising that awareness is something that I think that we can do, and we just had a webinar for accounting educators last Friday, where we had a section that was private company counsel, used some of the slides from that AAA session. There does seem to be an appetite and interest among the academics. So I think once they become more aware, then that will help push the ball forward. I did have people contact me after that AAA session and ask for the slides because they wanted to use them in their classrooms. So I think it was effective. We just need to keep going.
Yeah, we even, during that webinar that we just did for educators, we even made that point that we didn't get a chance to make during our panel with the AAA, which is that there are even questions on the CPA exam nowadays that deal with private company alternatives.
The only thing I would mention, because I know, Candy, this is one of the things I think you have been very interested in, too, is how we can provide whatever outreach we can, and maybe that's something that we can have as a project for us, is to brainstorm periodically on what things we can do as a PCC group or suggestions we can provide to FASB to continue to provide that outreach. How can we do it? And how can we do more than the 38 at the conference, which I think was a great start, though. I was glad we went to the AAA because I think that's a great start, but maybe there's some brainstorming we can do to continue to do more, because I think if we can get to the educators, that's huge. So anyway, thanks. I was hoping that'd be some of the response. But.
Anything else on the town halls that we want to cover? Okay, thank you. All right. So we will move to our next topic then, which is on effective dates. Is the team here? Okay. You want to wait? We can start? Okay, sure.
So during our last session with the PCC, we had gone through some early thinking in terms of why we were looking at this area and some possibilities in terms of the philosophy as it applies to major projects. And since then, the board met and they made decisions related to that and issued an exposure draft that I think you're familiar with. The exposure draft got into an approach that would be applied to major projects, including leases, credit losses, and then leases, credit losses, I'm sorry, and hedging, thank you, and then separately insurance. So the proposal that's out there, we're seeking comments, we're looking for feedback from everyone around the table. It really is based on a two-bucket approach. So in the first bucket, it's all public entities that are SEC filers, and then excludes those that are small reporting companies as defined by the SEC. And so it would potentially change the effective date for leases, pushing that back for public business entities an additional year. It would change the effective date for CECL as it relates to public business entities as well, and then hedging. So the proposal's out there. It's out until comment until the 16th. That's okay. And we look forward and would like to hear comments from PCC members. One question in particular that I'd like to highlight that's in the invitation to comment relates to interim reporting. And we had a lot of discussion about interim reporting, particularly as it relates to whether it should be for interim periods that follow the fiscal year of adoption, or whether it should be in interim periods within that year of adoption. So with that, if there's anything else that you guys want to add, or I'm interested to hear what PCC members have to say about the exposure draft and what you're hearing in terms of comments from others.
Who would like to kick us off? Rick.
I'll be mouthy. I'm warmed up already. I like it, and I think it mirrors kind of what was said at the last meeting, where I think FASB indicated they wanted that flexibility, and it seems like you've built that in to where you have that 2-year time lag, but you're not held to that, depending on the issue. And I think it makes sense, as we talked about at the last meeting, and then reading it through. Yeah, I think it makes sense. I think it achieves what you want it to achieve, and I like it from someone who represents private companies. That I think it's good flexibility and allows for a good time lag between when public companies have to implement versus when they have to implement. Gives us a guide. So no, I like it. I am curious as the discussion goes on if you've received any responses yet, because I can't imagine anybody not liking this really, but.
Yeah, I want to echo what Rick said. I think the feedback that I've been hearing across the board has been positive on this one. As far as the question on if you want it interim reporting, my preference would be subsequent year. Typically what I find with private companies is that they're going to apply or adopt new issues when they do their year-end financial statements. And then after that, they'll bake it into their normal financial reporting. But I've rarely seen a case where you get into Q1 of a year of adoption, and that's when they've already implemented the standard. They're going to wait until they're doing the year-end close.
I'm not sure. Let's see, Yen?
I was going to echo Jeremy's comments, I think specifically on the question about whether to affect the standards for interim periods. I would definitely prefer the interim periods following the year of adoption for both private and public clients. I'm sorry. I mean, for the smaller reporting company that are subject to the deferral. So if I'm reading this, the proposed effective day slides correctly for, yeah. No, sorry.
Jim? Next.
Just, Rick, your question about feedback to date, probably the most visible feedback was an article in the press from someone from Moody's that was very concerned about a delay between private and public company adoption. I think their concern was Moody's rates both private and public debt, and so obviously there's already a delay, but a longer delay would make that more difficult for them to rate comparable companies. Interested in sort of PCC perspective. Obviously there are private companies that have debt rated. I would suspect the vast majority by number of private companies, just if you said what are the privates that have debt rated versus the total population of privates using GAAP, the total population would be much bigger. So it's something we have to think about, but that's the one piece of feedback I think that we've heard maybe going the other way. I think otherwise the feedback's been pretty positive.
I agree that the constituents that are solely private companies, very positive. The constituents that are solely public kind of staying out of it. It's those that serve both that are saying this actually will increase our costs. So like your firm, Jan, that serves both, you'll have a longer spread, so you'll still have to do all the training for all of your partners for the public companies, and then will you have to retrain come private. So that's really where the additional cost can come in if you have a practice that serves both.
Can I just answer that real quick? I think for firms our size, we actually for the same team that will serve both public and private. To us, I know it's a prolonged process, but it's a very effective learning process for our practice as well. So the lessons, pitfall they learn from the public company side, they'll turn around and help our private company in a much better position.
Do you have, Marsha, you took your plate down? Okay. Sue?
So we had our annual meeting with IMA the other day, and they had some representatives there from their private company committee. And one of the things when this issue came up in the dialogue is that for many private companies, it doesn't really matter, this interim question, because they don't provide interim financial statements. And there may be a population of perhaps more sophisticated private companies that do provide interim financial statements. And so there was sort of an acknowledgement that that this interim issue really didn't matter. In other words, if you're only preparing annual financial statements, you're still going to go about it the same way that you would have gone about it, preparing it as of the end of the year. And so I just wondered, because of that, and notwithstanding the public company aside, since we're talking private company counsel, whether that had any bearing or impact on perhaps your views of whether or not we should just have it all aligned such that interims are in the same year.
I think, Sue, just to respond to your question, I agree with Jeremy that the following interim periods is most appropriate because, as he stated, everyone does annual financial statements, and if you ended up needing to have interim statements, you would already have your annuals done. So if you fell into some sort of bond covenant or something that required full GAAP interim financials, then you would already have your annuals done. It would be, I think, difficult to do at Q1 for any type of private company that would need to file that.
Okay, but I guess I was under the impression from some of the feedback that most private companies don't actually issue interims.
They don't necessarily issue interims, and the ones that do don't issue full GAAP financials. There's not notes and things like that, so it's not technically full GAAP. So it would be helpful to have that in the year of adoption to be under how you filed your annual.
So I think the application of a standard is to a full set of financial statements.
That's right.
Yeah,
Right.
so, okay.
Frank, you're next.
Yeah, I'm in support of the two-bucket approach. It makes a lot of sense. And my other comment was going to be exactly what Sue brought up, is I think there's a lot of private companies that don't necessarily produce a full-blown set of interim GAAP-related financials, but there are a lot of companies that do certify to their banks and lenders that the interim quarterly financials, for example, are derived from financials that are otherwise, where GAAP is otherwise applied consistently with the annuals. And there may be some nuances as to whether or not a new standard only applies to a full set, but I think that would bring up a whole host of questions. So for the companies that do have to certify, I think it makes a lot of sense to require the subsequent periods afterwards.
Christine?
To that point, with respect to the quarterlies for public companies, I'm going to ask Yen this question, and I know this is private company counsel, but I want to take advantage of you while I have an opportunity. I just wondered to what extent, since the quarterlies are required, you're going to have Q1, Q2, Q3 potentially under old rules, then the annual comes out, switch to the new rules, and then Q1, Q2, Q3 of the next year are under the new rules, so now the comparatives are not comparative unless you go back and restate Q1, Q2, Q3. And if you combine that with modified retrospective versus retrospective, transitions and sort of the complexity that there can be in some of the transition guidance, I just wondered how all of that impacts the your perspective on whether for entities where quarterlies are required and are going to be very common among these small reporting companies, if you feel any differently about that. So do you have any concerns about the complexity, I guess, and the non-comparability within entities?
I guess my comments is really related to the resource issue a lot of our smaller public companies are facing. So if we were to require the interim to be effective during the year of adoption, they almost accelerated their requirement for start implementing the standards. It put a significant constraints on the accounting staff. With respect to the comparability, I guess that's really standard specific. Some of the standards require, full retrospective. So some other ones may require like modified perspective. To the extent of the company's management really concerned about comparability, they'll have a more condensed pro forma discussion in other parts outside of the primary financial statements. So I think that's the bridge between the information they're going to disclose to investors versus the amount of actual work they have to get the full blown of, interim financial statements GAAP certified.
So let me just, so to the extent that they're followed by data aggregators, though, it's not going to be probably the pro forma information that's picked up. So, the users might be pulling that data from a data aggregator's database. Right? Okay.
So my views have evolved as it relates to this topic. I started out believing that these determinations should always be made by the board on a case-by-case basis based upon the facts of what is changing and whatever standard you're setting forth. But I think, I think the where you've gotten to is a great deal more transparency over over what's behind the thinking, what factors are relevant. And so from that perspective, I think it's a good thing for you to have this, this document that says, these are the reasons why we would choose this route or the other route. My concern about where you've seemed to come out is really in the two-bucket approach. And when we talk about the effect of the, on interims, is a really good example of how, in theory, the small public reporting concerns could cause you to drag private companies into into the second bucket and treat them less generously, if you will, than you might otherwise, because if when you exercise your discretion, you're saying we're sort of bound by this two-bucket approach, then you might sort of have the considerations for small public companies drag private companies into a less advantageous position and maybe inadvisable in that situation. So provided that you completely reserve your discretion in any and all cases to deviate from this, that's perfect, then that's perfectly fine. But I'm concerned about how the two-bucket approach might be rigidly applied to disadvantage the private company constituents.
David Lomax?
Yes, I'm a proponent of the two-bucket approach as well. I think that certainly whatever industry that you're in, the topic in question comes into play as far as how much delay should there be in implementation. For the surety industry, certainly the one that stands out the most is leasing. And now with a 2-year gap, it does create comparability issues. So fortunately, a lot of sureties have already taken the leasing standard into account as far as how they treat leases in their financial statement analysis. Overall, I agree with Jeremy's comments on the interim financial statement reporting. I think that quality comes into play too, and I agree with what you said, Candy, about non-GAAP statements, and that's very typical. And we do see in surety quite a few interim statements. I'd say the majority of our accounts do provide interims. So it's something that we use as a measurement tool over time. Certainly, you look at the fiscal year-end statement, and make your decisions based upon that, and it's more of a monitoring as far as interim financials are concerned. So overall, I agree with the approach.
So just a broad comment and then a more specific one. The broad one is I don't think I have any objection to the two-bucket approach or the delay. I'm just a little curious as to why, kind of in with Tim's comments here, as to why there has to be bucketing or a framework put together instead of just doing it on a rule-by-rule basis anyway. But I think a delay, especially for the private companies, letting the public companies sweat it out first is probably a helpful thing. The specific comment about the interim reporting, I stipulate up front that I'm weird. But when I was a CFO, it had driven me nuts to have the first 3 quarters on one thing and then coming up and truing it up in the fourth quarter. I would have insisted that my companies start engaging it right in the first quarter and not having this, back to Christine's point, having a comparison back each quarter and the first 3 being wrong. We provided ours to banks all the time, and then to turn around and tell the bank that in the fourth quarter we made all these changes and the first 3 quarters were wrong, I just wouldn't have done that. One solution would be, instead of going 2 years, go 3 years and make sure that the first quarter of that third year is on the same system if we're worried about the delay. But that's just my view on the interim piece of it. There's no way I would have implemented something in the fourth quarter.
Can I ask you a question on that? How about, say on leases, and having the software necessary, how would you see leases as far as, your comments on doing it the year of implementation?
Well, again, I think I'm a little weird, but I would have started in the fourth quarter of the previous year instead of in the middle of the year that I had to implement it in the first place. So, given the fact that there's 2 years in advance notice already, a delay, surely we can get up to speed in private companies and get this implemented. Granted, I know every time we come here that they will delay, and if Beth were here, she would state this too. They're going to delay as long as they can, but I would have incorporated this up front, is how I would have done it. It's easy for me to say that now that I'm not doing it, but I think that I can state that now that I would have done it this way. Yeah, for sure.
Mike, one thing to keep in mind, though, is a lot of the ASUs will have it where early adoption is allowed. So you would have that if you were the CFO in that situation, you wanted to early adopt in Q1 of the year of application, you could, but what we're talking about is not requiring all the privates to do that. So if some of them don't have the resources for whatever reason, then they would have the ability to go, great, when I get to my year-end close, that's when I'll deal with adoption, and then going forward, from that point forward, I'll have it.
For sure. So I'll put my user hat on. If I also would have gotten the first 3 quarters and then a fourth quarter weirdness because all of a sudden we're going to implement a bunch of standards, that would have seemed weird to me too. So I guess in that sense, like, again, I'd go back to the point, like, if we need an extra year to do it, then make it 3 years and start it with the first quarter, not do this weird first 3 quarters and a fourth quarter. Having said that, I know that you all come in and help in that fourth quarter for a lot of these companies, which is when it happens, but maybe help in the fourth quarter of the previous year to get ready for the next year, I guess.
Right.
Russ.
So I want to follow that. And I'll ask Jeremy this, but and I recognize the decision-making framework, and we have historically given interim periods a different break. What I've never understood that is when the primary change is income statement related, it sounds very inefficient for me. So revenue recognition is going to be required for private companies at the end of this year. So if you audit a software company, which I assume you probably do, they might have a change. You're going to come in, what I hear you saying is you're going to show up maybe in November, December, and then definitely the following February, March, and you're going to say those transactions you did 12, 14 months ago, you need to redo them. So can you help me understand, what are the conversations that you've already had with your clients that know this is coming? And is my gut that this is colossally inefficient? Maybe it's a pejorative word, but for income statement items. And so I'm trying to think should I think about this different for income statement changes versus balance sheets? Because leases is primarily a balance sheet. You could probably do a journal entry at the end to figure out your discounted amount from your footnote, and there's probably very little change to the income statement. But revenue in certain industries has a drastic change, and it seems like you're going to have to redo those. And then I don't know how, if you ever give any assurance on internal controls, how you can do that when the accounting policy was different in the first quarter than it is today, and you're covering that. That's what I never understood about this approach.
Okay, there's a couple things baked into there, so I'll take these one at a time. With the inefficiencies, I totally understand where you're coming from. I think part of it, though, is with the private companies, at least the ones I work with, just like it talks about in the PCTMF, they have access to management, so they're aware that, for example, with RevRec, they may not have adopted it in the quarterly reporting they provided to the creditors, whoever they happen to be, or the investors. So there's definitely some inefficiencies in there, and because everyone understands that, for example, 606 hasn't been applied, they understand that when they get to the year-end close, they're going to go back and apply it for the entire year. And from the management side, what I see more often than not is they understand that that the transactions are started and finished in the same quarter or in the same year, so they're not as stressed about it.
Okay. So that would imply that there isn't a material impact from 605 to 606, but in the ones where there are, so if you have a 3-year software license that would have a significant material impact, they are having to redo the accounting for that transaction by not adopting at the beginning of the year. That's my inefficiency point. And what I hear is management's okay with that. My question is, does management even know that? Are you having the communications with them in 2017, 2018, that as the beginning of 2019, you're going to have a switch, but we're going to have you redo that at the end of 19?
So I've been having, part of what you talked about, I've been having discussions since 2015 about this. So the boards and audit committees that I work with have been aware of everything involved, the five-step model, the amount of runway that the FASB's provided so that management can evaluate this and bring themselves up to speed. Now, with that being said, I'm the external auditor. My influence is fairly limited on how management implements this. And moreover, with most private companies, to your point on internal control, we're not providing any assurance on internal control. And we're only evaluating that when it comes to our year-end audit.
What do you mean? But ours in the internal control throughout the entire period, not at the end?
It is, but my point is when we're performing our year-end audit is when we'll look at internal controls that were in place throughout the year. So if they decided they're going to implement 606 and they're going to modify their internal controls, and that all happens in Q4, and we're performing our audit of the year-end financials, then fine. We will understand the controls are in place throughout the year as well as the changes that took place at year-end for RevRec.
That control assessment is no different than a public company that adopted retrospectively.
Okay.
Public companies restate prior years, and if they elected retrospective, and obviously they didn't bookkeep that contemporaneously, and they're not getting adverse control opinions, and they're
So you'd be testing the controls associated with, in essence, the retrospective to the beginning of the year.
Right.
I think you're right, Russ. As far as on RevRec and impact on income statements, we've not seen any, upstepping of, on interim reporting as far as implementing RevRec at all. So then it begs the question, what is being done behind the scenes? Is there a separate set of books? Because is it going to lead to delayed issuance of 1231 financials? When the auditors come in, what are they going to be faced with? Those are some of the questions that we're looking at.
So I'm very comfortable with interim the year after. It's what we've been doing, and I haven't heard concerns to date in the private company community. We've been doing that standard by standard since the PCDMF. So I, Tim, take your counsel very seriously about this. This arose not because of concerns in the private company space, but because we bucketed public companies with private companies. And that if we then let the smaller number of companies that get into that bucket then cause us to make determinations for private companies, I think we have to be very cautious about doing that. As it relates to public companies, obviously they have the flexibility if they want to go down the path that Michael talks about of adopting at the beginning of the year. I think virtually every standard we've issued that's had a defer for interim has allowed early adoption, and certainly early adoption as of the beginning of the period. And so they can elect in that space. I think it's been a while, but I think the SEC's rules deal with the comparability issue. That is, when you reissue your quarters the next year, you have to recast the previous quarter to be comparable, even if it's a modified retrospective adoption. And so I think that comparability, that's an SEC rule. I don't want that to get into the private company space. And I think as it relates to a standard like RevRec, I could see the complications, but I think at least in the public company space, we don't have data for private. The vast majority of companies do not have a material impact. And so that allows the ones that don't have the material impact to continue and figure out a process at year end. For those that do, they have the flexibility. Causes more thinking, I think, by auditors and others to plan for that. But I haven't seen a problem with it today.
So I just wanted to add on to the comments about that sort of how the second bucket includes some public business entities now, and it's not just the smaller reporting companies. I'd be curious for those around the table that do have public clients, whether you think that cut on eligibility is clear or not. By law, the Jobs Act allows for emerging growth companies to also elect the private company effective dates, including the effective date for interims. And the cut is SEC filers and all other entities, so it could include other entities that are public, but certainly, as Jim said, going forward, the board has the prerogative to consider the entities that are within that pool and allow for some flexibility by allowing those that are public to elect early.
Tim?
So I just wanted to quickly mention, Mike was, I think, sort of talking about from the sort of preparer's perspective, wanting to do Q1. I think, and in one of his remarks, he was sort of channeling Beth, but I'll do that as well and say, when you have a bank covenant, usually you have to deliver your year-end statements within 90 days and your interim statements within 60 days. Maybe it's 60 and 45 or something like that. But usually you have much more time to do your year-end statements than you do your quarterly statements. The reality then is the reason you have 90 days for your year-end is because you need 90 days to do your year-end. Which, so I describe this interim issue as a Q1 issue, right? If you're dealing with old GAAP for the first 90 days of the year to get your year-end financials, and then you have 45 days to issue your Q1 financials, then you're compressing all of the work to do your accounting changes for Q1 into that 45-day period. Because, as much as you might like to think that private companies get way ahead of things and implement things way ahead of schedule, the reality is they don't start until they have to start. And so you're starting a change, starting to change your accounting methodology in the middle of April when you got to do your statements by the end of May for your Q1. So, I think from a preparer perspective, there's just really the practicality that interim really means a real compression of work in Q2 to do your Q1 statements, and that presents a real practicality issue.
Yep.
Even more to the point.
So just on that, and probably don't need to belabor it, but we had 90 days because we had an auditor look at year ends, but interims were 45 because we didn't have an auditor. It was just counting on us to deliver it. So the additional delay wasn't a matter of implementing additional accounting. It was because we had an outside body come in and look at our financials. And we had covenants that we had to provide monthlies to banks. To Dev's point, I don't know, frankly, I think that they were just testing us to see if we could actually produce them as opposed to actually looking at the content of them. So I could have scribbled a little cartoon and sent it in and see what happened. But, to the point about, to Jim's point about going back and retrospectively, and again, maybe this may be just personal implementation of it, but it would, to go back and then try to convince my CEO that, hey, I'm going to spend a lot of time doing retrospective Qs on these, instead of just up front getting it done and getting it done the way I wanted it to be done, just seems to be kind of a waste. But again, maybe that's my own approach to doing the financial reporting as opposed to the reality of what a lot of other firms are facing.
Yeah.
Thanks. As I hear Tim's concern about the two-bucket approach, I'm just trying to think out loud here. I know we try to develop the framework really for the longer run. So even though we have some of the major standards out there, so if I take a look at the two bucket right now, well, I just want to throw it out there. Would that make sense to put the small reporting company and the other PBE back to bucket one, but on a standard by standard case, and then sort of kick it down to apply the same adoption standards as the bucket two, just so we don't cloudy the water or mix, for purpose of the private companies or the other companies that's ended up in bucket two to begin with. Just a thought.
Yeah. So I have the pleasure of chairing our Small Business Advisory Committee, and many of the concerns, and this is outlined in the PCDMF as well, many of the concerns specifically as it relates to resources and education cycles apply equally to companies in that space, and the PCDMF acknowledges that. So there was some thought as to, we're public companies, we're perfectly happy applying the same standards as other larger publics, but some consideration on, well, we also need some additional time because of those resource constraints, I think, is one factor. The other thing relates to what I'd mentioned earlier in terms of emerging growth companies. Currently, by law, and our proposal doesn't change anything related to these entities, emerging growth companies allow for the those entities to elect the private company adoption date by law. So by including SRCs in that second bucket, the objective was to provide those entities that often have less resources than the emerging growth companies with the same accommodations that are currently provided by law for EGCs.
Anything else? I do think, Alicia, that Tim does raise a good point, though, to, you know, we don't want the private companies to drag along the small public, you know, with the small publics. If y'all decided to just, you know, to make a decision that, you know, for the small publics, it needs to be this date, but for privates, it wouldn't necessarily need to be that way. So I think, you know, as long as the document gives you flexibility to do that, I think that'll be fine. Did you get your question answered earlier? You did? Okay. Anything else y'all need? Any other comments? Good discussion. Thank you. Okay. We are now on to topic 3, which is our reference rate reform. Morning. Great.
All right, get started. Thank you, Candy, and good morning, everybody. So at this stage, we've had several sessions talking about reference rate reform project with the PCC. So in some of our previous sessions, what we talked about was the background to reference rate reform, which is that there's this market-wide transition that's happening for LIBOR and certain other interbank offered rates that are expected to be discontinued in the next few years. And then we previously talked about some of the previous board decisions and the board's objective as it related to this project, which is essentially trying to address the accounting issues that have been raised by stakeholders as it relates to this market-wide transition for these rates. And the board has been looking at trying to ease the operational burden associated with having to assess voluminous contracts that are going to have to be modified during this transition period. And then secondly, the other broad area was assisting companies with relief for certain hedge accounting evaluations so that hedge accounting could continue during this time period. And during those sessions, we received some feedback from the PCC, which was around, as we were thinking about the proposal, to think about providing examples to illustrate some of the principles that we had previously discussed, specifically around when we talk about contract modifications and we say what terms are related to reference rate reform and what terms are unrelated to reference rate reform, providing examples to illustrate that. So we welcome that feedback, and we included some of that when we came up with the proposal. So that leads me to last week, which is now we have an exposure draft that has been published. So it's publicly available, and the comment letter period is open, which will close on October 7th. So we're really now in listening mode for this project, and we're looking really for stakeholder feedback from all avenues, so we'll welcome all feedback. But obviously for the session today, so the objective is to kind of go through and really pose questions to the PCC. To help facilitate the discussion today, we prepared a paper which outlines some of the key aspects of the exposure draft, and included in there certain questions to help facilitate the discussion, and that's what we're hoping to achieve, I guess, in the next 30 minutes or so. So with that, I was just going to start off with the first question that we had outlined in the paper, and then we can work our way through it, which was, so the first question is, from a readiness perspective, we're trying to get a sense as to what progress companies have made and other organizations have made in identifying and mitigating the risks related to the transition away from LIBOR and any other reference rates that might be affected by reform. So we're just interested to hear from your perspective how you feel your clients or companies are trending.
Jeremy, you want to go first?
Sure. I've talked to clients about this, the ones that where this is going to impact them. They're only aware of it if their lender, the creditors, are making them aware of it. That's as simple as what I've seen across my client base.
Jeff?
In our previous meetings, I've been asked, are bankers aware of this? And we certainly are. But over the years, so much of our pricing is reference rated anyway, and even smaller customers have asked for LIBOR. From my view, I think replacing LIBOR as well, it's about time. The way it was calculated was absurd. But we will come across customers who will insist, we don't care, we want LIBOR. And in some cases, particularly with very, we'll figure some way, and as I understand it, there will be there will be some banks continuing to calculate LIBOR. So it's not going to go away anytime soon, and I just want people to be aware that when the replacement goes into place, there'll still be a few customers, a few borrowers getting LIBOR. But with respect to what the topic 3 is proposed, I think that's fine. It needs to be as simple as possible, particularly because some of the pricing formulas that we have are really complex anyway. So go for it. Just don't think that LIBOR is going to disappear tomorrow. Unfortunately, it won't.
And so from my client base, we serve both, just regular corporate, but we also do financial institutions, smaller financial institutions. So some over $1 billion, but a lot of smaller financial institutions. And I would say that I have seen no movement on the financial institution part to try to address this. I spoke with one of our, I would say, more sophisticated CEOs very recently, and although he was aware of it, he didn't have a team in place. He didn't have an inventory of the loans that were priced at LIBOR. So, to my knowledge, there had been no communication to the customers that, this may need to change or anything. So I think from the financial institution space, especially from the smaller financial institutions, there's not a lot happening on the proactive part about, moving things off of LIBOR or even communicating to customers. So I think there probably is going to need to be some movement fairly quickly on that, in that area. And he was, like I said, aware of it, but had not, started any type of gathering of data, I guess.
Can I just follow up? Is it because some of these people think that LIBOR is not going to go away, or is it like, what's the reason for why there's no sense of urgency?
Well, it's they're expanding, and they have, they're in new markets, and, it's just another thing to add to the list of things they need to do. So.
And I think you'll find in smaller institutions, they may not be using LIBOR as much. They're going to be using their variation on their base rate or prime rate. As you get into the regional banks where we compete more on pricing, we're going to be using LIBOR or its replacement rate. But certainly the Risk Management Association has probably for the past couple of years been publishing articles, white papers on LIBOR's disappearance. But when you get into the under $1 billion market where some of Candy's clients are, it's less of an issue. Nevertheless, they generally among the larger banks, they're certainly aware. But there's going to be this range of awareness and doing something about it, because, as Kenny pointed out, there's a whole list of other things that are way, way above the replacement of LIBOR. And even now, the consciousness of lease cap is just now sort of breaking into the banks. So you've got a lifetime employment opportunity.
Christine?
Just wondered after you had that conversation, if you got a sense that there was any change in a sense of urgency, or was it just kind of falling on deaf ears?
No,
I
no,
just
I don't-
wondered how they responded.
I think he was, oh yeah, I need to, and I need to get on that. And this particular institution, he and I were having the conversation about how big is your portfolio, that might reference LIBOR. And he said it's probably larger than you think. And so I said, okay. And so then maybe we need to do something. And he was, yeah, this is just, it wasn't on anybody's radar. So it wasn't on the, the chief risk officer or the chief lending officer. It just wasn't on anybody's radar. And it, in a small institution, it's got to get on somebody's list or it doesn't get done. So, Jim?
Are the examiners or regulators asking this when they come in? Because you would think that'd be one way to sort of elevate it to the highest levels if the examiners had this as a priority. And maybe they do. I don't know.
I'm not aware of anyone having a conversation with an examiner about this. There may be some that are out there, and I would actually assume that as it gets closer to maybe the phase out, that there will be definitely conversations with examiners. But I don't think, at least in our client base, that it's happening yet. So.
I can affirm that it's not high on the regulators' list yet, simply because they're more concerned about concentrations, real estate, the LIBOR. There may be a question about whether you're aware of it, but they're not being held to task for it yet.
Sorry. Dev, I had a question for you having to do with public-private partnerships. What's your expectations on those? And do you believe that this optional expedient for contract modifications, would work for banks?
I'm sorry. The question was directed to me.
Yes.
Oh.
Yeah, having to do with public-private partnerships and how you would view those.
Honestly, I hadn't thought about that. Don't have a good answer. Good question. No answer. What are you all doing about it?
Yeah.
Back at you, man.
Thank you for the question. Great question. Actually, we're waiting for banks' responses. No. Actually, at this time, we've not done anything in that area. We see certainly an uptick in public-private partnerships in the construction arena, and but I haven't. Everything that we've seen, of course, has already been put in place. So not a reworking of a deal as a result of this.
Ask the question at our next meeting.
Okay. Thank you.
I have a question. I do see an uptick in the loan agreement lately that instead of just reference the LIBOR rate, there will be like LIBOR or other reference rate. So the term is a little more flexible now in some of our clients' loan agreements. So I'm just curious to the extent if LIBOR does go away at the end of 2022, I believe, right? So, and then the agreement itself is not substantially changed. They just switched to another reference rate. Would they be able to still use that Expedient, or is that really not a contract modification per se?
Yeah, that's right. So if there's already existing contractual language and typically, in the terms and conditions at the back, there'll be contingencies to say if certain events happen, then the terms will change this way. So one of those that's what is referred to as fallback language. So there might be contingencies already in certain contracts that say in the event that LIBOR stops being published, or language might say in the event that there's no longer a certain number of submitters of LIBOR. So there could be all different types of language. But once that gets triggered, then there might be provisions in the contract that then says the LIBOR rate is replaced with some other rate. And so if that's already pre-existing contractual language, to your point, you don't have a contract modification. That's just following the terms of the contract as as it was there. So this relief is really for what I'll call legacy contracts, LIBOR contracts that may not have that robust kind of language because it was never contemplated, this kind of event of it going away. And so there's this effort to update a lot of the contractual language to now have that kind of fallback language in there. But I think to the point there for new issuances of LIBOR instruments, because we are monitoring and still seeing there's significant volumes of still LIBOR-based instruments still being issued, but likely or hopefully that'll start having some of this fallback language that'll contemplate LIBOR, so that's not a modification. So they wouldn't need any practical expedience.
That's great. I think I do see an uptick in that, the new language that's now been used in a lot of the loan agreements.
Just another comment. Many loans are done on notes without loan agreements, and particularly shorter-term instruments. So consequently, the reference rate language typically isn't in the note. It just simply will be a blank and then fill it in. As you get into longer-term notes, as you get into larger relationships, you will. But just as Jan has seen an uptick in interest in this, it's interesting to me that this has become a very popular webinar compliance ops risk sort of. Hey, have you checked your loan documentation to see if it's ready for the disappearance of LIBOR? So there is that kind of activity going on. But again, I think you all should be aware that a lot of loans are done strictly on notes without loan agreements, particularly, again, smaller relationships and smaller banks.
Okay, so just in the interest of time, maybe moving on to the next question, which was around some of the proposals of the expedients in the exposure draft themselves. So we were just curious to see if any PCC members had a chance to read and had any reactions to the proposals within the exposure draft itself around either contract modification guidance or the hedge accounting evaluations guidance.
I looked at it and I was fine with it.
Yeah, I also read it and thought it made a lot of sense and would be easy to implement.
Okay, great, fantastic. Well then moving on to question 3, which is about disclosure. So within the proposal, it's the current proposal, it's really aimed at providing optional expedients and doesn't issue any new required disclosures as it relates to interest rate exposure. There's no current gap that requires entities or reporting entities to disclose their LIBOR exposures or other things. But one of the questions we had in the exposure draft is, given this market-wide event happening, is that type of information something that the board should be considering to require entities to start disclosing? And in the basis, there's some discussions about potential ways that might be done. But really, we're looking for feedback both from preparers to understand, what the costs and the complexities that might be involved in compiling that information, and equally, we want to hear from users, or we'll be looking for user feedback to see if that type of information would be valuable and useful, and how would they plan to use that information. So we're just seeing if there's any kind of thoughts around potential disclosures, whether that would felt to be warranted either for users and how preparers would feel about that.
On the issue of disclosures, for me, and I looked at it when I read through this and the question, how would I want my client to react to this? And frankly, information that you all presented at the last meeting was informative for me as well as my partners when I went back to talk about the issue for them as far as the LIBOR rate. And I didn't realize the political volatility of the LIBOR rate. I mean, I learned a lot at the last meeting in regards to that. So the questions that I have, or the type of disclosures that I thought would be informative, granted, it might already be in there, and I just didn't see it. But the things that I think would be informational for a client that I might have, or another user on this particular issue, if they're not that familiar with LIBOR and so forth and that type of thing, is why is LIBOR used, why the change in the rate, why SOFR versus any other kind of rate being more appropriate. And then what's the effect of using the new rate? I mean, those things but they're all very general, and I understand that, but just from a reader standpoint, I would understand a little bit more about what the issue is, why there's this transition, what the effect of the transition is. Just general information for me as a reader would be, I think, important, and I would understand a lot more about what the client is dealing with and what the effect might be. So again, very general, might already be in there, but those are just questions that I had when I was reading through this that I think I'd want to know.
Can you elaborate on that last one, what the effect of the transition is? So are you thinking in terms of sort of more general qualitative terms of effect at a macro level, or are you thinking more in terms of the effect on the specific entity? And is it the effect because of their exposure? Is it the effect because of the practical expedients they've taken advantage of? Would that be quantitative, qualitative? So just a few more bars on that one would be helpful.
I understand. And I was looking at it more specifically. So if I was looking at a particular entity, what's the effect of this change to this particular entity, and why, as a user or reader, why should I be concerned about it? What does it really mean to me and this entity because of this change? Is it dramatic? Is it not so dramatic? And could be qualitative, but I was looking at it more quantitatively at that point. Does that help?
It sounds like, at a minimum, some quantitative understanding of what the exposure is so that you can determine if it's material or not.
So I'm going to ask a follow-up question, too. What if your client only gives the financial statements to the bank that did the loan on LIBOR?
And I understand. And you might think, well, what would be the additional cost of having that disclosure when the banker knows full well of what the issue is? Again, to me, to many of my clients, would it be worth the information to have in their note disclosure? I don't know. But I think it'd be valuable information for them to understand this is the effect, this is why we're going through this process, and but should it be a requirement? I get it. I get the issue of why should I have something in there which I really don't care about, but the banker does, and so why are we costing more money to put that in there? I get that.
Jeremy?
Where I come down on the disclosures is just focusing on what's known, what's certain, and limiting it to that. So what's certain is, okay, LIBOR's going away, and that if this issue went through, that it would be deemed non-substantial, depending on what the language is for the various agreements that we're talking about. And I would limit it to that. The hypotheticals, as far as anything else, I really would caution against that, because I think that's where we start getting into trouble trying to apply that in practice. And to the comment on, well, the users in the case of the bank would already know it. Unless they're restricted use financials, I have to assume they're general use and then go out to others that may not be aware of these changes. So I think just simply saying, okay, yeah, the company and the details about the credit agreement are already in the footnotes, saying, yeah, we have whatever it is, a line of credit, a note, whatever, that is based on LIBOR. That's already in the existing disclosure. So all you're talking about is baking on top of that. LIBOR is going away by the end of 2022, and when it goes away, whatever the new terms will be, it's intended to be non-substantial unless other criteria are met.
So Rick, my concern about broader disclosures about impact is really there's all kinds of risks out there that may be larger than this one. Trade risk and what agreements I might have, cybersecurity risk, LIBOR to SOFR risk, and I'm just wondering, particularly for and MD&A covers that for public companies. Obviously, private companies can choose to do some type of commentary, or they more likely just have a discussion with their users. But I would have thought, let's say I have some LIBOR products and I'm moving to SOFR. The whole objective here was to move from one variable, relatively risk-free rate to another. The company isn't going to be in a position to manage whether that's a smooth transition or not. That's been done by the ARC and others. But if it works well, the idea is I went from one variable, relatively low risk rate with some spread, to another relatively low risk rate with some spread. So I would have thought for the vast majority of companies, they'd kind of say, well, I went from one rate to another. Both variable, both trying to exclude credit risk. And I don't know what they would do beyond that.
And that might be enough, Jim, even just saying that, just to alert the reader that, hey, look, it's no big deal. We're required to go from this one rate which we used historically, blah, 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 and over to the SOFR rate, which is more appropriate, less volatile mechanism, and the effects are negligible. I think that might be
effects,
enough.
if everything works well, are negligible. We can't manage whether it works well.
Yeah, but I think that might be enough just to explain why are we even dealing with this issue? Why is it a standard change and it's a temporary thing, that's going to go away in a couple of years as far as the note disclosure? I
guess just have a follow-up question on the effective date of the disclosure. So you're proposing to have the disclosure effective as soon as the standard is finalized, but it's going to go away at 12/31/2022. Is that the plan?
Yeah, and sorry, just to be clear, so the proposal itself doesn't have any of disclosure requirements that we're talking about. This is a question in the exposure draft. So it's a great point. So the intended effective date as it's currently proposed would be effective immediately, and that's because this is all about providing optional expedients. Everything's going to be optional to apply. You don't have to apply at this current gap that you can still apply. But if we were to have required disclosures, the point being raised there, we would then have to think about an effective date, because then obviously people would need to have time to understand how does those disclosures work, to collect the information to do that. So that would have to be worked through if the board decided to add additional disclosures, but that's not being proposed currently. These are just outreach questions we have, because we want to collect feedback to see whether the board wants to take that on.
So if I could just follow up, so along those lines, then, did you have any thoughts or concerns that we should consider in terms of?
So I guess you're asking whether the company will start putting in their disclosure the type of Expedia they're intended or expect to elect. I'm just trying to think through exactly what sort of disclosure, because it hasn't really happened yet. But so you're asking for information ahead of time, their expectation stuff. So that's the part I'm not entirely clear.
I think some people believe. So some people believe that we don't need disclosures. This is about relief to help companies transition to something that they're not really a party to. And we should allow them to not have to go through the details of the 10% contract modification test. I think others say that that's fine, but there needs to be a forward look about what is the potential exposure. That's kind of the first disclosure requirement or ask. Again, board hasn't required that. The question is should we do that? Then the second one is when there is a modification, should there be some kind of disclosure about what is the impact? Because while there's not a plan to have a winner or loser, there likely will be a winner or loser between the bank and the corporate. So should the corporate determine if they won or lost in this transaction? Clearly, if you do that, that's going to require work, require effort, and it could require more time, which would alleviate what we're trying to achieve. So this is a question, not a board conclusion, a question about should we do that, because we've got input from some that says we should do it.
So, Frank, I'm going to put you on the spot. If they were to go down this road, what do you think, what type of effort from a preparer standpoint that would?
I think about what Russ just said a minute ago, which is you're asking a company to predict something or forecast something to which they're not a party and have no input into trying to negotiate or come to agreements. I think it'd be very difficult. I think it'd be very difficult to sort of look into a crystal ball and try to come up with those kind of forecasts.
There's not a forecast. So the first one would be is how much of your notional debt or other contracts are based on LIBOR? That would be the first one. That's
Which is easy.
The second would be is if you had a change from LIBOR to SOFR, what is the impact of doing the practical experience? So there's no forecasting. You've actually modified your contracts. What is the value associated? I think that's the 3B, right?
I think one of the uncertainties, though, Russ, is we don't know what it's going to be changed to. at this point. The discussion a little bit earlier that the banks are just now getting on board is true in the experience that I have. I think there are a lot of private companies that have multiple reference rates already baked in, to Jan's point and to Dev's point. I know in our case we have LIBOR base, we've got I think a bank base rate, and I think there may be one other reference rate. But for those that are just LIBOR specific, I'm not sure they know where they're going to go. I'm not sure where they're going to go. And also, from a private company standpoint, I'm not sure that the private company has the type of expertise to understand, well, what does all this really mean? Because what you typically do is you turn to your bank, or in some cases you turn to your accounting firm because they've helped you in cases to say, can you guys help me figure this out? So I think that's the practical challenge.
Okay, so again, in the interest of time, what I'm going to do is just combine the last three questions and then just open it up. So really the last few questions, one is around the termination date or the sunset date to the guidance. So the current guidance as it's proposed in the exposure draft is that these practical expedients will expire at the end of 2022, which would mean then any contract modifications made after December 31st, 2022, and any new hedge accounting evaluations that are performed after that date would be defaulting back to what's in current GAAP. So these optional expedients would kind of go away. So it creates just this window to utilize these optional expedients. The other questions are just then really, are there any concerns from auditors or preparers around just implementing this guidance, which I think we got some of that feedback before. And then lastly, if anyone's hearing any other accounting issues that are coming up that weren't dealt with in this exposure draft, so we can start inventorying and looking to see if we need to address those.
I was pretty relaxed about the idea of the sunset at the end of 2022 because I presume that the board in 2021 can say LIBOR is not going away as quickly as we thought. Let's make it 2024. So I think the concept should be there, but the date you can figure that out. As it relates to disclosure, I think the most disclosure you should do on something like this is we've gone from LIBOR to something, and we've elected this expedient, we're done. That's the disclosure. And getting beyond that, I think, defeats the purpose of what you're trying to do.
Yeah, I was fine with it. I think it's workable. I didn't see any issues with it. Following up on what Tim's saying, I think where you want to maybe provide a little bit of clarity would be what they should be disclosing if they haven't executed the contract change. So if they're in the process of doing that, are there different disclosures? Do they disclose less because there hasn't been anything that's been formally executed yet, or whatnot?
I do have a fair number of clients who their fiscal year end is March 31. I presumed December 31st, 2022, that's the day that we expect LIBOR to go away. I guess just think out loud, there may be some clients that may just call in between the dates, but I think there's enough time between now and December 31, 2022 to the extent we have to modify the dates. There's still probably being an option out there.
Yeah, and just a clarification, so the current expectations is that LIBOR will go away at the end of 2021. So we've built in another year buffer, if you will, in that 2022 year date. And then to the point raised earlier, and this is also articulated in the exposure draft, is the board is going to stand by and monitor this market-wide transition. So to the effect, if they're getting close to 2022, they need to push it out, the board would be able to make that decision and make that change.
Any other comments or discussion on this topic? Did y'all get what y'all needed? Okay. Mm-hmm.
So I'm very supportive of the termination date, but the FASB, to my knowledge, has never done anything like this. And so I think it's important, recognizing the beginning discussion, that this doesn't appear to be on a lot of senior management's radar screen in the private company arena, where it probably should be. how do we get the word out that this optional simplification goes away? Because it goes away. And the reason the board has done that is because we don't want to allow for transactions, say in 23, 24, 25, that aren't related to this systemic change, where then you could actually have a negotiation. So I think we need to figure out how we can communicate to all of our stakeholders that this is a limited time offer, if you will. And I'm not sure how to, Jeremy has said over and over and others is that there is an educational gap at this area, and this is really important to get out. And that's just something I think we can all work together once this is finalized.
Right, and I would agree. I mean, I think it's something that we need to start, putting in our PCC, minutes and everywhere we can, that so we can alert people, work with, other trade organizations like the ABA and the state societies just to make sure that everybody understands.
In the context of, I think we should all try, is there anything we ought to be doing differently? They're not even aware that the underlying economics are going away. So the fact that there's some accounting that might go away at some point is probably secondary to the fact that they're not even aware that the transaction they've entered into, the fundamental basis, isn't going to be there, which is why I wondered if regulators or others are out there saying,
Right. Well, and I would venture to guess that, many private companies may not have ever had to apply this guidance to begin with, and so they may not even know that they would be subject to it. So, because they've never had anything that would make them subject to it. So, I think there's a lot to consider and to try to get the message out about.
Just one question kind of on this. Is this going to be viewed as something that's going to take a couple of years to probably start to work through? Do we see banks like saying, this is the year we're going to change all of our clients over from one reference rate to another? And in the sense that, like, back to, I agree with Jeremy's disclosure thing, like, we're applying this change. You kind of put this disclosure, we're applying the one-time expedient that FASB, et cetera, that we are changing everything over from one to another, and that's kind of a way through the disclosure mechanism by saying you've got a one-time shot at doing this. But I know less on this topic than any other topic on the agenda, I think. So it's not clear to me, like, when they do this reference rate reform change, do we expect we're doing this because we expect a one-time shock to this as this goes away. Are banks thinking about this taking 1 or 2 years, or?
Yeah, so I can maybe help shed a little light on that. So we've had, through our outreach discussions with certain stakeholders, mainly in the financial institution space, so what we've been hearing is there's really kind of two market structural issues that they're having to grapple with. So starting off with derivatives just broadly. So derivatives now are largely centrally cleared, and they follow standardized protocols that are published by the ISDA organization. So one of the benefits of that is that given that everyone has to sign up to these standardized protocols, they can make amendments to the fallback language so that this contract modification will kind of happen all at the same time or very closely together. The difficulty when you move away from derivatives are now cash instruments, so you're talking about loans, credit cards, all these other types of agreements. Those are all bilaterally negotiated contracts, and so there's no centralized mechanism to do this fundamental shift. And that's where it gets very operationally and legally challenging for the banks and the institutions, is they're having to go and work through these negotiations to amend all those contracts. And so that's one of the difficulties, is you're going to have a disconnect in the timing in terms of what products will switch over and how quickly they switch over, just driven by how they're structurally set up. So it's a long way of saying that while there probably will be a big effort to get most of the contracts moved over before the end of 2021, I'm sure there will be this tail, this lag of numbers of contracts out there that may just never get modified because the two counterparties were never able to get together and agree to amend those.
I wouldn't affirm that, Mike. What you're going to see are there will be a group of loans that are going to be maturing or renewing in the next year or two, and that's commonly half of your book. Even term loans on average only run about 3.2, 3.3 years. So the majority of loans probably will renew or be restructured or mature, this will not be a big deal if they renew or get restructured. Then we'll switch over from LIBOR to SOFR or whatever other alternative reference rate. I suspect a lot of banks will go back to doing prime rate financing and get away from the LIBOR concept if they can. But there is going to be a tail to this, and that's where the rub will be.
Just one comment real quick. I think given what Russ is saying, that FASB never done this before, I think once this ASU does get finalized, instead of having the transition date or effective date at the very bottom of the ASU, that should be the first thing that should blast out. It says going away at 12/31/2022, and make sure everybody stay focused on the effective date instead of put it toward the very end.
If I could just quickly say a few more words about messaging, the dates and all that stuff. Obviously, I think we need messaging out there so that people know that the relief will be out there. In terms of the accounting relief going away, as David mentioned, it's going to go away a year after LIBOR is expected to go away. So really the messaging in terms of something going away should be more on LIBOR going away. And people will eventually know when LIBOR's gone away because their cash flows will change, right? If you have LIBOR-based assets or liabilities, all of a sudden your interest payments are going to change. So that's, people are going to know that in advance, well in advance of the accounting relief going away. So I want to make sure just that people are clear on the messaging in terms of the timelines and the sequencing of the events.
Alex, can maybe so when this says here, would apply to contracts and other transactions that reference LIBOR or another reference rate that is expected to be discontinued. Can you just list those and say, is that just impossible to actually do that? And I'm seeing that's shaking your head, yes. So you just can't, because that would be one way to also sunset this thing, is you know that these are the 5 that we're giving you the exception for, but it's more complicated than that.
Because it's around the world. So like LIBOR, there's a TIBOR, which I think is Tokyo. So
it's just impossible to list the ones that you want to give as a exception to this.
Yeah, and then there's other rates that they are either currently undergoing review or they're about to undergo review. So if we did a prescriptive list, which is one option we explored, the downside to that is anytime a new rate would be added to that list, the board would have to get back and add that to the prescriptive list. So that's why the board moved towards explicitly saying LIBOR, so everyone knows it definitely applies to LIBOR, don't have to think anymore about that, and then having this principle, which we describe what it means by a rate going away, that will then hopefully people can apply the principle, use their judgment to determine all these other rates that will be going away, whether this applies to it or not.
And if 3 years from now, there's more certainty around which rates are going to go away, and maybe we need to extend it by a year or two or whatever, we can revisit whether maybe at that point in time there is a finite list that we can come up with at that point in time, or if we need to keep the principle. But so we can think about that, a few years down the road as the market evolves.
Maybe it's me and there's just something I'm missing here, but why does it need an expiration date? If the possibility of other reference rates going away exists and you don't know that they're all going to be wrapped up and put to bed by 12/31/2021, why not have this open-ended? What am I missing here?
Yeah, I think the main aspect, which may not apply to a lot of the stakeholders on the PCC, but for the hedge accounting relief side of the proposal, a lot of that is, for lack of a better word, essentially suspending certain aspects of hedge accounting evaluations, which will allow people to continue the hedge accounting debits and credits during this transition period. So I think the board was comfortable doing that to allow these hedge accounting relationships to continue because there was going to be this end date. And so if you hadn't transitioned everything to the new rates, you're going to default to current GAAP, and if following the hedge accounting rules, if that's no longer a good hedge, you'd be knocked out then. So it was really putting that, I think the safeguard was really more for the hedge accounting evaluations.
And if I could also just add, GAAP already has guidance on how to handle modifications. So we don't even need to do this, right? We're doing this as a temporary relief to help people with the high volume of modifications that are going to happen. There's going to be temporary market dislocations, so that's the other reason. But eventually, this goes away, and you're just left with what we have today, which is the existing GAAP guidance on modifications. So there's no hole that we're filling here, basically.
Okay, all right, thank you. Okay, now we will move to topic 4, which is distinguishing liabilities from equity.
That's it, right?
Big team. Okay, which one of you is going to lead us off?
I'll be starting off. Good morning, everyone. So today we'll be giving an update on the Distinguishing Liabilities from Equity project, as well as the exposure draft that was just issued on July 31st. So getting right into it, our first slide here provides an overview of the project objective, scope, and proposed improvements. As we have communicated to the PCC members before, the objective of the project is to reduce the cost and complexity in financial reporting for convertible instruments and contracts in an entity's own equity, while also improving the relevance of information provided to users. The two main areas addressed in the proposed update are convertible instruments and the derivative scope exception for contracts in an entity's own equity. The current guidance for convertible instruments includes multiple complex separation models, some of which would be eliminated under the proposed update. The current guidance for the derivative scope exception often leads to form over substance accounting conclusions. The proposed update would reduce these form over substance classification outcomes by requiring entities to disregard remote contingent events as part of the contract's evaluation under the derivative scope exception. These changes are expected to provide immediate relief for private companies and small public companies. In addition to the changes to convertible instruments and the derivative scope exception, the disclosure guidance would be amended. Although many of the disclosure requirements in the proposed update appear to be new, much of the guidance has simply been reorganized to improve clarity. Only a few new disclosures would be required. For example, for convertible instruments, an entity would be required to disclose the conditions that affect conversion and the party controlling the conversion option. For contracts in an entity's own equity, the entity would be required to disclose terms of contingent events that are significant to the contracts. Next, we'll take a closer look at the proposed changes for convertible instruments. Overall, the proposed update would simplify the accounting for convertible instruments by eliminating some of the separation models in the guidance. This would reduce the number of conversion options that require bifurcation, while also increasing the proximity of GAAP interest expense to cash interest expense. This next slide shows how the accounting models for convertible instruments under the current guidance would be changed under the proposed update. Out of the 5 different models for convertible instruments under current GAAP, 4 result in separation of the embedded conversion feature from the host instrument. The proposed update would eliminate the cash conversion model, beneficial conversion feature model, and the substantial premium model. Convertible instruments with conversion features that are required to be accounted for as derivatives under Topic 815 would still be separated. All other convertible instruments would be accounted for under the traditional convertible debt model or the traditional convertible preferred stock model.
The second area of focus of the project is the derivative scope exception for contracts in an entity's own equity. And this area provides guidance for assessing whether a freestanding instrument or an embedded feature may be exempt from derivative guidance. The overall improvements from the proposed amendments are an increase in management's judgment and a reduction in the strict rules that are characteristic of the current guidance. The proposed changes lead to a reduction in form over substance classification outcomes for these instruments. Next, we'll discuss some of the proposed amendments made to the derivative scope exception. The amendments in the proposed update are consistent with the board decisions that were shared with the PCC in the April 2019 meeting. One proposed amendment is that contingent events that are remote of occurring will no longer be considered for evaluating the indexation and settlement criterion. This prevents remote features from driving an instrument's classification. In addition, 3 settlement conditions are removed, reducing the number of additional settlement conditions from 7 down to 4, and I'll go more into detail on those features on the next slide. The board also decided to reduce the frequency of assessing whether the derivative scope exception is met. The amendments in the proposed update would require the reassessment only upon the occurrence of reassessment events, such as an adjustment to the instrument strike price or the number of shares used to calculate the settlement amount. I want to clarify that the reassessment occurs when the triggering event happens and not when the likelihood of the remote contingent event changes. Moving on to the proposed removal of the settlement conditions. This slide shows the 3 removed settlement conditions. The first condition requires that a contract explicitly permit settlement in unregistered shares. The second condition requires that there is no collateral. And the third condition is that the counterparty rights cannot rank higher than shareholder rights. Under the proposed update, having these features in a contract will no longer prevent an instrument from meeting the settlement criterion. Next, we will discuss the proposed transition guidance. A modified retrospective transition with an option for full retrospective is being proposed. Under the modified retrospective method, an entity would apply the proposed guidance to transaction as of the beginning of the year in which the amendments are adopted. Transactions that were settled or expired during the prior reporting periods would not be effective, and the cumulative effect of the changes would be recognized as an adjustment to the opening balance of retained earnings at the date of adoption. Under the full retrospective method, an entity would apply the proposed guidance retrospectively to all instruments outstanding as of the beginning of the first comparative period. The cumulative effect of the change would be reflected in the carrying amounts of assets and liabilities at the beginning of the first period presented, and the offsetting adjustment would be made to the opening balances of retained earnings for the first period presented. A transition expedient has also been provided for the derivative scope exception in relation to reassessing the likelihood of contingent events. Under a strict application of the transition guidance, an entity would have to have retroactively identified whether a feature had remote likelihood of occurring at contract inception. Due to the difficulty and costliness of making this assessment, the board provided a transition expedient to allow an entity to assess the likelihood of a contingent event as of the date of adoption. And finally, for entities that have not yet adopted Update 2017-11, which addresses accounting for certain financial instruments with down-round features and is not yet effective for private companies, early adoption of the proposed amendments will be allowed for convertible instruments that include down-round features that are subject to the guidance in Update 2017-11. I'll give an example to illustrate this amendment. Under current guidance, a convertible instrument with down-round features is accounted for under the embedded derivative model. Upon adoption of Update 2017-11, that same instrument will transition to be accounted for under beneficial conversion feature model. Upon the adoption of this proposed update, that same instrument would again transition from beneficial conversion feature model to traditional convertible debt model. And that would result in 2 transitions for the same instrument in a very short amount of time. And that's not only costly for preparers, but it provides no benefit really for users. So under the proposed early adoption, convertible instruments with down-round features will be able to directly transition from the embedded derivative model to the traditional convertible debt model. And finally, the staff would like feedback from the PCC members on 2 specific questions from the proposed update that are particularly relevant for private companies. The first is, are there any specific private company considerations in the context of applying the private company decision-making framework that the board should be aware of? And then going on to the second question, how much time would be needed to implement the proposed amendments for private companies, and should early adoption be permitted? Thank you.
Okay. Who wants to kick us off?
And we're also happy to answer any questions if there's, questions about the proposal or anything we run through before we get into the discussion question, if that's helpful.
Okay. I guess I actually did have one, and this is not my area of expertise. So But the removal of the settlement conditions when the settlement is permitted in unregistered shares just seemed a little bit odd.
So there's currently a condition that precludes, so you can't be equity classified if you have to settle in registered shares. So this takes away that condition. So you don't have to analyze if you have registered or unregistered shares to settle in.
Right. So this is probably the only thing that I've come across in the last year that, I mean, they didn't have the shares to settle. So it was, difficult to say that it should be classified as equity when you didn't have the shares to settle it. So I guess I was curious about that.
Yeah, and this shouldn't be confused with, there still is a condition that you need enough sufficient authorized and unissued shares to settle the contract. So that wouldn't take that condition away. So this is probably less relevant to the PCC members, this unregistered shares.
Right.
But the requirement was kept in place that you do have to calculate if you have enough authorized or unissued shares. But with that, they explained the reassessment event. So for example, if at the beginning of the contract you did not have enough shares, but you later got board approval or you had more shares that came in that were authorized, then in that case you could reclassify from liability to equity if all other conditions were met.
Tim?
I'd just like to say that I think this is a welcome simplification, and it doesn't seem to me to be any reason why you wouldn't want to early adopt. Those who would early adopt would do so because it cleans up the balance sheet, makes life simpler, and presumably in the longer term, in addition to, facilitating more readability in their financials, in the long term, it'll probably save them costs. So I'm totally supportive.
I'm totally supportive of this simplification for private companies. As you're going through the presentations, I was thinking through how we're going to apply it for some of our public reporting companies. One of the questions that Kenya raised about the unregistered shares. So we have more than once number of occasions where the company didn't have enough authorized shares for one of the quarter, and then the subsequent quarter they got the authorizations, so they have to reverse all the charges that they took in the prior quarters. So I just think out loud. I know that's a very important guardrail out there. But since we're removing the requirement for unregistered shares, will there be any appetite to think through whether shares could be? I guess for a public company, it is now. I'm like thinking out loud myself. It's really hard because it's not really within management's control to say they have enough shares to settle this. So maybe that's off the table. But I also think the transition you're talking about, companies where they implemented 2017-11 on the down round feature first, and then have to unwind this. That's just going to create a lot of noise in their financial reporting, to the extent if we can maybe provide an example of how a company can maybe aggregate the disclosure requirement to disclose the net impact of this, that would be helpful.
I think of what Russ mentioned a couple of meetings ago. When it comes to simplification, I'd be in favor of early adoption being allowed.
Jim?
So I think that the line between the change we're doing for registered shares and authorized shares it's the least important to me. The issue of registered shares, I think, came up because people had that in the contract, and the question became, if I have insufficient registered shares, what is the likely penalty? And many companies said what I would likely do was if I didn't have the registered shares is deliver unregistered shares and then get them registered. And I think the accounting position was, no, if you don't have that, we should just presume that the contract provides for cash settlement. And I think attorneys would come back and say that isn't the likely method. It's not even a legal option. So I think we were comfortable with that one. The one that says I've issued a contract that requires me to deliver more shares than I actually have authorized seems a little harder to say that that one is equity. Obviously, sometimes people go in and out of that, but that seems like entities ought to be able to plan ahead for, why am I issuing a contract but I don't have those authorized shares? And I'm not faulting any, it happens from time to time. It's just maybe a little less sympathy for for that situation.
No, I like the removal of the settlement on unregistered shares, because we do have clients that caught in the determination of whether it's registered versus unregistered. I think there's somebody even pulled out a 1996 SEC speech on legal definition of a registered shares, and you set up arguing with attorney whether that provision allows for that or not. So overall, I like the simplifications.
Anyone else? I think this was a good step forward, and, you know, this simplification should make it easier for those entities that have this in their space. So. All right, thank you. Okay, so we are running just about 10 minutes ahead, so we'll go ahead and take our break. It'll be a 10-minute break, so why don't we come back at 5 after 10. Thank you. Thank you all for reassembling. And we will now pick back up with topic 5, which is our implementation topics, and specifically on leases. So, team?
Sure, great, thank you. So what we're looking to do is get your feedback on the issues that you've been seeing and the questions that you have for us. We had a good discussion with Tick, who had brought up a handful of items in regards to the new leases standard that they thought that the board should take a look at, and we'll talk about that more when the board meets with Tick. We are monitoring the issues that come out of the adoption of leases by the public companies, and we're going to continue to do outreach with them, as well as the larger firms and so forth, to see you know, what were the key issues that they faced with the standard. So what we'd like to use this session for is to get your feedback or to field any questions that you have. So I'll stop there.
Anyone want to go first? Rick?
You know, and I did appreciate the discussion we had yesterday with Tick. I think they had some good thoughts and good suggestions, and I know you guys will all be talking to them later today in regards to those. But the one thing that, and it came up yesterday too, that I would encourage and would be helpful, and we mentioned it in yesterday's discussion, is the related party type activity and guidance that can be put around that, because we're getting a lot of questions in regards to what can be done in a related party lease transaction, and are there games that can be played, and I guess, yeah, probably. And so any kind of guidance or more guidance might be helpful there. That's the kind of questions I guess we're getting now.
Does that relate to the interaction between the at least in part, the relationship between the related party guidance and then how you would account for leasehold improvements?
No, it really might deal more with the terms, and when can terms be adjusted to remove the obligation to record the lease, and if it's a related party activity or transaction, is it easier to do so or not, and when should the terms, what terms should be followed? And I think just an email exchange I had with both Jeff and then Chris was helpful to me as far as guiding me to the specifics of the contract. But that type of thing, I think, would be helpful to have more recognition that there might be some gamesmanship played with that, and it'd be helpful to know what the expectations are.
So really, you're asking, did we really mean to use the contractual terms? Right? I mean, that's what it says, use the contractual terms?
Yeah, it says that, and when you look at that, you look at it like you would look at a lease between unrelated parties as well. So you wouldn't just look at, let's just say it's a month-to-month lease, you wouldn't just look at that, you'd look at if they have the right to renew, and you would think about all of that when you come up with lease term, because those are forcible rights.
So what I was getting at, what I hear from your question, and maybe I'm not interpreting it right, is if you had just say a 6-month lease with no options to renew in a related party, we'd say it's a 6-month lease, right? And what I hear you saying is that can be circumvented, and maybe we should. Are you asking, should we literally say it is only contractual, or should we be looking at de facto options because it's a related party?
Yeah, I guess the difficulty, particularly from an auditor perspective, is so you have this lease, and if it's an unrelated party, well, it allows, I think, some comfort to know that if I have a lease arrangement with Jeremy and both of us as unrelated parties have agreed to remodel or restructure our lease to be either a month by month or less than a year, and yet from an auditor standpoint, I'd look to the reality of the transaction to find out, okay, should I be encouraging or as an auditor, what risk do I have if the lessee chooses not to record the lease because they have this arrangement. Now, knowing that Jeremy is a lessor, he's got some risk in this. And so if both of us agree, okay, we both have some risk that we're willing to take. In a related party situation where I'll get questions is that, well, okay, I'm not likely going to kick myself out of the building that I'm leasing, and so I'm going to restructure this lease and therefore really circumvent the spirit of the standard. Now, that's okay if that's the intention, but
It was.
Okay.
At the unanimous advice of the PCC at the time.
Okay.
Yeah, and I think the discussion was we don't impute other terms in other related party transactions. You can have a revenue transaction. We don't say, well, a market participant would have bought it for this. We say it is related party, disclose that fact. I think we thought this is related party, disclose that fact, as opposed to asking the company and the auditor to divine the unwritten fair value, market participant exchange between two parties. And so I think if it didn't have renewal options and it was a 6-month lease, I think the board was clear that is a 6-month lease, not, I think.
I think that the only thing that, and I mentioned this before, is, the embedded leases in some of these agreements. It's a little bit difficult to explain that. One, education, to people, and then to help them identify, how that is to be accounted for, and everything that goes with that has been a little bit challenging in certain circumstances. So I don't know if there's any additional, guidance or education that can be done for private companies in particular in that area. But I think that's that's obviously the most complex piece probably of this. And so whatever we can do to help educate would be welcome. It's making them think of what the possible inventory is. That's it. It's getting your arms around what the possible inventory is. And I'm fair to say that when we did the lease disclosure, the 5-year lease disclosure, probably these embedded leases maybe weren't considered in that because no one was forcing them to think about it or forcing anyone, the preparers, to think about it in those circumstances. So it's not like we have an Excel schedule that we can go and just pull and use.
So as part of the proposal to defer, I think Russ talked about doing some roundtables or workshops to get, and this is, I think, part of that, to get a list of the inventory, and that's one that, as I've given or gone to conferences, is surprised me. I mean, we knew things. I mean, I think that initially came up with power plants, where a power plant's built next to your facility, and you're getting all of the capacity, and effectively you're just leasing the power plant. And I always thought of it like in that context of large things, and you start hearing stories about people saying, we have plants in our offices that somebody comes in and waters. I suspect they might own the plants, and somebody says, well, the pots that they're in are leases. The plant isn't, because it's biological, and the watering is a service, so you got three things: a biological asset, a service, and you're leasing the pot. It would have never occurred to me. So I think getting some input through these, I suspect those are by and large immaterial, but I think it illustrates the point that maybe some smaller things, maybe we could either get educational of how you could more quickly sort through that, or what we have to do. The other one that comes up, and I know it was on Tick's list, is the discount rate. Was surprising to me, the struggle that and it seems, I don't know, maybe that goes away after adoption, but it seems a lot harder than I think I would have thought.
Yeah, I agree with that. On the embedded, what I think would be helpful is real fact patterns on embedded leases, so we can judge how material are the embedded leases in relation to the underlying service. So in other words, if it's 5% of the contract, that's going to be a different philosophy than if it's 95% of the contract. It's clear. I mean, I wouldn't say maybe. It's clear these weren't tracked, and it is what it is. But I think having a better understanding about the population, and is there a different perspective if it's a 90%, 95 versus 5 or 10% would be helpful.
I think in the healthcare space, there's a fair amount of these that you think you're having the service, but you've got to have the pill dispenser in order to, for the pharmacy to replenish. And so there's that. I think there's some things like that are popping up. So. Anybody else have any other observations? We know Tick is here and ready to discuss. We won't take their thunder. So ready to discuss this afternoon some things that we talked about yesterday that we think, would be beneficial for private companies. So we're anxious to hear how that discussion goes this afternoon. Anything else? Okay, thank you. Okay. Yeah, we are running a little bit ahead. So.
Yeah, I was thinking Jennifer should have a balance sheet.
About, okay, we're going to flip it? Yeah, we'll do.
Her PTA's participated.
Do we want to? Technical. Oh, okay.
I just emailed her.
Okay. So which one are we doing? Are we going to flip or not? That's what I'm trying to figure out. Yeah.
I'll be right down.
Okay. Okay, so we're going to move to topic 7 so you can get your materials ready, but we're still waiting on one person. Because we've upped him about 40 minutes.
Morning, everyone. So we last spoke to the PCC in April of 2019 on the balance sheet classification of debt project, and during that meeting, we provided a project update. The board recently met at the end of July on this project, and during that meeting, the board discussed several sweep issues that were raised by external reviewers that we will briefly touch on here today. They also completed redeliberations, and the board gave the staff the go-ahead to finalize the revised proposed update. In advance of this meeting, the PCC members should have received the July 2019 board meeting handout, which provides additional context or details around the content of what's in the slide deck today. In terms of timing of the revised proposed update, we do expect it to be issued within the next week. It could be issued as early as this week. There will be a 45-day comment period on that revised proposed update. Next slide, please. So as a reminder, the existing rules-based narrow scope guidance would be replaced by an overarching principle that could be applied to all debt arrangements. In that classification principle, debt would be classified as a non-current liability if either of the two following criteria are met. The liability is contractually due to be settled more than 1 year after the balance sheet date, or the borrower has a contractual right to defer settlement for more than 1 year after the balance sheet date. Now, moving into the sweep issues that were discussed in July, the first question that we received was, how would that classification principle be applied to debt arrangements in which its contractual terms require that it be entirely settled in equity? So the board clarified that you would determine classification of those types of debt arrangements on the basis of when it's contractually due. So regardless of the form of the settlement, look at the contractual terms of the arrangement. So we have a question for the PCC. Based on what I just explained, do you think the debt classification principle would be operable for those type of debt arrangements in which, again, the contractual terms require it to be entirely settled through the issuance of equity?
From a banking perspective, as long as it's a liability, it's a liability. What really matters is whether it's subordinate or subordinate to our relationship. How it's paid out is moot to me.
I guess, Dev, I'm surprised at that answer, because if the only means by which it's settled is through issuance of a security that is definitionally subordinate to the bank, I'm not sure why the bank would be concerned about the settlement of something that is, in my mind, it's no claim on company assets. It seems to me that the whole idea of classification of your balance sheet is intended to signal to lenders something about the priority of the right-hand side of your balance sheet. And so it seems to me entirely counterintuitive to think that something that has no claim on company assets could ever be a current liability. And it seems to me questionable as to why it's a liability at all, because all it is dilution of the existing shareholders. But having said that, it seems completely illogical that something with no claim on current on assets of the company could or should be deemed to be a current liability.
Until it's paid out, it's a liability to me. I never pretend that we bankers are intuitive. David?
Yeah, so to answer your point, Tim, so in a subordinated note payable situation, we allow the current portion of the debt, and if there's a subordination agreement in place, then we would allow that as equity. And typically, the long-term portion, we would prefer that the note have a duration of 2 years, 24 months or longer, as opposed to something truncated, and then it's more deemed to be more current, if it's, say, less than 24 months. The question that comes into play is there are some note payables that are subordinated both to the bank and to the surety, so you get into a matter of, rights and entitlements and that. There are other notes that sometimes are only subordinated to one or the other. So we always, are mindful of a note payable that the bank has that we do not have as surety company.
But to be clear, my understanding is the fact pattern is not just that this is a subordinated note, but rather that it will never be settled in cash. It's only going to be settled in equity. So it's far more subordinated than just subordinated debt. It's debt that will only be settled in equity. That's the way I understood the question to be posed.
Well, again, follow up on David. Look, as long as it's good news if it's subordinated, but what we find in banking is they'll say we have subordinated debt, but in fact, the payments are typically not subordinated. And so if you're talking about truly subordinated, we would certainly be delighted because it would be subordinate to our debt, but it's still a liability. And life is simple for us. It's either equity or it's liability. In that it might be equity later is terrific, but I'm sitting there with an outstanding balance on my borrower has on our note. Until it gets paid out or get paid out through equity, it's a liability. And the way you describe it, that we have many borrowers who feel that way, but hey, tough. It's a liability.
Tim's point, it's not that. Tim's point is should it be a current liability? So what I think the board concluded is if it's stock settled debt and it's required to be stock settled on June 30th and it's your 12/31 balance sheet, do you want that in current or long term? I think Tim's saying he would have preferred to be in equity. He can accept it to be debt, but he'd want it long term because current is supposed to depict that there's a current draw on assets, and this is no draw on assets. Is that fair?
In that case, sure.
So it'd be okay in your mind to have it as a long-term debt?
Yeah.
Yeah.
As long as it's a liability, we don't forget. We're the elephant in the room.
Yeah, I think, too, we look at, is it an interest-only note, which is quite common. So, meaning that, it's quasi-equity on a go-forward basis. And a lot of times it's, a sole owner or primary owner of a private company that's saying, this is a way to create, equity, and what can I do with that equity? Procure credit as a result of it. So a lot of times, might be quarterly only interest payments or whatever, but so we always have to look at the foundation behind, why does this note exist? What's the purpose of it? Is it really going to be paid, in the terms of, of the note itself, or is it for the purpose of really, that I'd have no intention to paying this back even for the period of the note itself?
Just my understanding of the fact pattern that this might depict is, something that's documented as a loan, but they haven't figured out what the price is for the underlying shares to be determined, so you don't yet know how many shares it's going to convert into, but you know exactly that it's going to convert only into shares. And so for so long as there's for so long as you haven't fixed the number of shares into which it converts, it gets reported as a liability, but it's always and only going to convert into shares. And so that's where my sort of disconnect is. It's not, again, not a cash, not a drain on the company's cash. It's just a liability because you haven't fixed the number of shares. In my mind, that should certainly never be a current liability.
Yeah, I agree with that.
I think I have a clarification, maybe a question. So we're talking about share settled debt. So it's at the holder's option to demand 100% share settlement with not a cash option. Is that correct? So for share settled debt, it's definitely a liability. And then I think in the spirit of simplification, do we need to make more additional exceptions for classification purpose?
That's really the question, right? So share settled debt, there's no option here. It's not going to really share settled debt. One view is follow if it's classified as debt, everyone follow the same thing and look at the simple, is it required to be settled in 12 months? Others would say, no, you need to look at the consideration to settle the debt, and the cut for current is based on use of assets, not use of equity. That's why we have the question. And it sounds like maybe you and Tim.
Right. I don't see a whole lot of shared settled debt in a private company space, actually. But if we followed accounting, it is a liability. So if the guiding principle is like I said, it's a simplification for a liability. To me, I think I would have go for just simplify it and look at the contractual term.
So this isn't. The example was share settled debt, but this applies broadly. So think about some of the instruments that we just got done talking about in liabilities and equity that might be legally equity, but they are accounting liabilities. I think those would be in the scope of this. They require share settlement. You see those instruments. They're not called share settled debt. They're called warrants. They're share settled. If they have to be share settled in the next year, I think those would be current liabilities, which I think raises Tim's question about is debt classification or liability classification about solvency. If it is, that causes some people to be confused about why this thing that could never have an impact on solvency is a current obligation. And it gets to me to the fundamental question. Some would say those shouldn't be liabilities to start with. I happen to be in Tim's camp. But if they are liabilities, they certainly shouldn't be current liabilities. And I think I hadn't thought about in the initial ED this issue. It got raised. And so the question is, should we have an exception? I think we got to that. The question is, should there be an exception for these, or should it be out of scope? Should we just follow the principle?
Well, I think our views on this are predictable. I mean, we're consistent based on the discussions that we've had in the past on this. I'm in Jan's camp. Not that I would have a problem if it would go the other direction, but again, if the whole idea of this is to simplify and provide clarifying guidance to promote consistency, at some point there's got to be, for lack of a better description, a line drawn in the sand, and I think that has. The way you've drafted the standard initially has done that, whether we're dealing with lines of credit or any of those type of issues. And yeah, I would agree with Jan that I think if it's a liability, it's a liability, and if it's current, it's current, and if it's going to be settled in the near term with issuance of equity, then we'll disclose that and make sure that the readers know that that's the intention. But as of December 31st or whatever the year end is, this is the facts of this particular obligation, and so be it. I mean, I just think anything else then leads to the discussion of, well, what else should we make exceptions for, which you've had those kind of discussions for several meetings too, and have wrestled with. So this is just another one of those issues, but I would, out of a spirit of clarity and simplification and consistency, that's the way I'd advocate.
So what I'm hearing is there's just a discussion on what's the priority. Is it focusing on how a liability is settled or when it's settled? And to me, when you're already talking about a classified balance sheet, you're automatically focusing on when it's settled. And you already have disclosures that would cover how it's going to be settled. So to me, I would prefer not having an exception for this, because that'll ultimately achieve more simplification.
Okay, so Tyler's going to finish up talking about the other sweep issues.
Yes.
Sorry,
Oh, I'm
Mr.
sorry,
Mike.
Just to put my 2 cents in too. So the question here is that we're trying to decide, we've decided it's a liability, so we have to decide whether that we're going to make this current. That's the question, right? It seems, if we've already decided that it's a liability, then it's going to be settled in the next 12 months, and it's got to be current, right? I mean, I can both agree and disagree with Tim here in the sense that it seems like it's not a liability, but if we're going to call it that, then we can't not turn around and call it current if it's going to get settled. So I think I'm confused, or not.
So there seems to be a consensus among the practitioners that, you either go down this path and look at when it's settled or not. I think Russ summarized my position that I don't think it should be a liability. I can live with it being a liability, but not so much that it's current. But hey, at some point, the cynic in me says, if you guys want to continue to call this a liability, then call it a current liability and deal with the wrath of people who say, this makes absolutely no sense. What are you thinking when you do this? How is this a current liability? So if everybody wants to sort of go down this purist approach to it, be my guest. It's just illogical, from that perspective. So have at it.
I got to respond to the illogical. So I think it's illogical if you view classification as signaling the how, because then that gets to the solvency question that Jim and Tim were talking about. And you would view this as illogical because, of course, it's not then signaling the how if you classify it as current. But to your point, if the purpose of the classification is to signal the when, well, then it's completely logical to have it as a current liability if it's going to settle in the next 6 months. So I think fundamentally where people sort of depart on this is whether they view classification as trying to provide information about how something's going to settle or when it's going to settle. And I'm in your camp, I'm in the when camp, so to me it makes more sense to have this current.
Anyone else before we move on? Okay.
All right, so now I'll just briefly go through some of the other decisions and issues that were raised through external review and discussed at the July 2019 board meeting. The first has to do with variable rate demand obligations with remarketing agreements. As a reminder, the board has previously decided to preclude the consideration of an unused long-term financing arrangement in place at the balance sheet date when determining the classification of other debt. We spoke with the PCC at the April meeting, and we walked through an example of a variable rate demand obligation with a remarketing agreement and an unused long-term financing arrangement. The first external review issue that was raised resulted from that decision on unused financing arrangements. The external reviewer observed that if a variable rate demand obligation with a long-term contractual maturity can only be put to the issuer by the holder upon a failed remarketing, the failed remarketing could be viewed as a contingent put. Therefore, if there is no failed remarketing at the balance sheet date, the debt would be classified on the basis of its contractual maturity, which is long-term, and classify the debt as a non-current liability. The board determined that no further amendments are necessary for VRDOs with remarketing agreements because the debt holder has the ability to demand repayment on the debt on short notice, and they will get repaid regardless of whether the remarketing is successful or a failure. The next issue that was discussed has to do with disclosures. The board also decided to remove a proposed disclosure requirement for events of default, which would have required an entity to disclose a description of the course of action that an entity has taken or that it proposes to take to remedy the default. The board also decided not to add a similar disclosure related to grace periods that have not expired before the balance sheet date. From a private company perspective, the board noted that the other proposed required disclosures related to events of default and grace periods would be sufficient to facilitate a user's review and allow a user to identify appropriate follow-up questions for management. The next issue brought up has to do with the definition of a current liability. External reviewers believe that there could be an inconsistency between the master glossary definition of a current liability and the current debt classification principle, simply because the definition of a current liability retains the notion of management intent, while the debt classification principle focuses on the contractual terms of the debt arrangement. The board discussed this at its December 2015 board meeting, and in the 2017 proposed update, they included a paragraph in the basis for conclusions that addresses the interaction between the master glossary definition of a current liability and the debt classification guidance. At the July 2019 meeting, the board decided not to make any changes to the revised proposed update and determined that the current explanation in the basis is sufficient. And finally, the last issue that was brought up in external review has to do with illustrative examples. Several external reviewers requested the board include additional illustrative examples in the revised proposed update. The majority of these examples had been previously discussed by the board. At the July 2019 meeting, the board concluded that the current examples in the revised proposed update are adequate and that no additional examples are needed. We understand that it is natural for stakeholders to request additional examples to ease the need for interpretations upon adoption of a new standard. However, the extent of the examples provided should be balanced with the project objective of providing a classification principle. That is, the purpose of creating a principle is to reduce the need for rules or examples to address every type of debt arrangement. And with that, I'll turn it over for any questions or comments.
Anyone have any comments on last items Tyler just covered? I know there is some discussion from not-for-profit entities that have the secured, the debt that's secured by a letter of credit. So I know that that's been something that has been discussed, and I do understand the issue. I still stand by what I said before. I think commercial, in the for-profit commercial environment, I think the decision that's been made is the appropriate one. Whether or not you make a distinction for not-for-profits, that could be something else. Anyone else? Okay, thank you. Okay, we're going to back up and do topic 6. Identifiable intangible assets and subsequent accounting for goodwill.
All right, good morning, everyone. During the last PCC meeting in June, you may remember that we've discussed some details surrounding the amortization period. And some of us may remember that there were some mixed views even amongst us in the room. Some people viewed the fixed period being the most practical way, and there are others in the room also who preferred management judgment on that. And so at that time, the invitation to comment was not yet issued. It was issued shortly after in July. We provided a 90-day comment period for that invitation to comment. And one of the important aspects that the staff is really trying to glean from that ITC is whether or not there is a cost-benefit issue that exists specifically for public business entities that warrant standard setting. Some of us may have read the invitation to comments, and in terms of the alternatives that were included in that document, it includes the private company alternatives as one of them, but there are also a lot of broader type approaches that are being considered in that document, such as what's listed there related to subsequent accounting for goodwill, recognition of intangible assets, potentially changing disclosures, and any implications on comparability. It is a staff document, and it does not represent any board members' views. You might wonder what we've been doing as a team since the issuance of the ITC, and to just let everyone know that the team has been actively reaching out to the valuation profession and the community, not only to better understand the mechanics of the models that contribute to and create goodwill, but also to actively better understand the cost-benefit issue if it does exist. Interestingly enough, and surprisingly, from the perspective of a few valuation specialists, Valuations and reporting requirements today have become so nuanced and specialized that many management teams are unable to prepare their own statements and disclosures without the significant help of significant outside help. And many private companies and some public companies can relate, as many of us here in the room know about that. And this perspective is particularly surprising because it's coming from practice partners in the field of business valuation, right? On the other hand, there are other valuation specialists that have expressed that business valuation itself have become significantly more standardized over the past recent years based off of the CEIV credentials that are now in place, a certified entity and intangible valuation credentials. So I'll pause here, just giving that update to see if there are any questions perhaps the staff can address at this time. Okay. Okay, now just to announce, and this may be quick, but just to announce as an update, we have a public roundtable scheduled for November 15th, where we expect to bring representatives to share their very varied perspective, for example, from the valuation profession and community. We expect that the members who will be active at that public roundtable to submit a formal comment letter prior to the deadline on October 7th. And that leaves us about a month before the comment period deadline and then about 2 months prior to that roundtable. My understanding is that the private companies truly like the options that they have today related to this project and topic, and not to really take that away from the private companies. So with that, are there any other questions or comments about the ITC or about the project? Rick?
I'm not sure exactly what I can offer here other than representing private companies. Yeah, it's a great thing. It's a great thing. You know, and I like the document, the ITC document. I think it gave great background. Where I really looked at it is the discussion of some who would argue that goodwill might have an indefinite life. And how? When I read that, it's like, how can that possibly be? And so, just intuitively, and that's why I like the ability to amortize goodwill to at some point to get it off if we're not going to go through the process of impairment, knowing that it does save on cost. And I understand why those entities who haven't had the ability to do that are looking at it now saying this could be a good thing for us, because they would, I think, share the understanding that goodwill can't possibly last forever. It just can't. Because what I buy or obtain from David's business is because of what David brought to it. And now that David's not there anymore, now it's my own goodwill that I now have inherently built into the business. So I get it. I would encourage folks that don't have this ability to grasp it if they can, and they don't have to choose to use it, I suspect, just like we don't in private company space. And I think it's a good thing, and I think it'd be a good thing for those entities. I could see why they would want it. And those who choose to think otherwise, bless your heart, but why? Yes.
I just wanted to address the word of the use indefinite life, because I think, and I made this mistake myself when I used to teach goodwill in class, and I didn't really think about what that word was intended to mean back when it was used by the board, when SFAS 142 was written. And it wasn't, if you go into the basis, it wasn't intended to mean infinite lived. That's the way that we often substitute the word infinite lived for indefinite lived. But what the board, I think at the time, was thinking was, yeah, it's a wasting item. I'm not going to call it an asset. It's a wasting item. But the period of time over which it's consumed and the pattern of consumption are unobservable. And so because of that, it's indefinite lived, meaning we can't definitively say period or pattern of consumption. And so the idea was that if impairment could be accurate enough, if that model could be accurate enough, it could be used to do a better job of sort of matching consumption to the period of consumption. So then I think that leads to a question, well, now, is this, given what we know about how the impairment model is applied in practice, because there are a lot of judgments and factors, and given changes that have been made to that model since it was originally issued, like the addition of step 0, the elimination of step 2, are those assumptions about that model being accurate enough to do the matching so that you don't need an amortization model that would do it sort of more systematically? Are those assumptions still valid? But I do think it's really important for us to constantly sort of correct our thinking when we start substituting that, and I think we all do it, and like I said, I've certainly been guilty of doing that too.
No, I stand corrected, and that is what I meant. So I appreciate that, and I know it was defined in the document, which I appreciated that too. So thank you. That's right.
So if you have clients, or if you yourself have elected the option, the PCC alternative, how often is the amortization period less than the default?
I have a couple that have selected less than the default period, and it was justified by kind of tying it to when the entity was purchased, the trail off of the business, if you will, from...
But the original, but that's because they adopted the change after the business combination. Has anyone seen where they've started and done less than the default?
Yes. I've seen it, and usually they peg it to whatever the multiples were that they used when they're valuing it.
Yeah, I've seen it too, Russ. For the same exact thing, almost always less than the default.
Okay.
Yeah.
Yeah, I just wanted to follow up on something Rick said, because I think one of the things that, along with exploring the models, the amortization period, the trigger-based impairment model, et cetera, is this idea of option, and whether or not it should be an option, particularly if we don't go down the path of allowing for amortization for public companies. And so what if it wasn't an option? Is that problematic? You'd be required.
Required to amortize?
Yes.
Well, I think it could be, but maybe not, because the argument might be, I first deal with the requirement. I suspect one of the exceptions, and exceptions isn't the right word, but one of the provisions would be if there's some significant happening that occurs within my business that would warrant a revaluation or reassessment of the amortization period to where it, whether I sold off a segment or whatever it might be, that there would be provision for me to adjust at that point. If there was, then I think it could lend itself to deal more with the reality of the situation versus just a straight amortization, which I think is what you're getting at. So I think if there's a provision for that, I think it would allow for that.
Mike?
So I don't know if you're coming here specifically for private company related issues upon which I don't have enough. I've not been in there to see what they're doing since this has changed. But just thinking about this more broadly as an issue, I guess, in some sense, is that, thinking about, I didn't do an entire literature review on this topic, but, the write-offs are seen as informative to the market. The amortization is not really, generally, from what I've seen. And the one concept or thought process that I had in looking at this, and I think this kind of applies to private and publics too, is that the idea of this holding management accountable for the asset or the item that was purchased in this notion of goodwill.
is that it is in the denominator of a return on capital kind of calculation, that being return on assets, for example, if you want to think about how management's being held accountable. When we're amortizing something like this, we're reducing that denominator, we're reducing how much capital we've said management's employed over time. And at the same time, the numerator has things like advertising or other types of things where they're trying to do something to maintain potentially that goodwill in the numerator. So in some sense, like if you want to think about how management's using capital and trying to come up with metrics on how they're efficiently using capital, something like an ROA, if you've got this capital that they've employed, we're calling it goodwill in the denominator, which typically I suggest that be included in that denominator, then their ROA is lower if they're not generating much numerator as a result of having employed that. This all comes back around to thinking about this invitation to comment, and we think about the amortization period. I was just trying to think about to what extent is what types of information in this is relevant. And I think the fact that managers are going and assessing this annually has been shown to be relevant to users of financial statements. And I'm not sure the amortization. Another question about whether or not we should have management decide on how long or the default. I would imagine it's going to be less than 10 years, because if you take out the amortization, we don't view that as valuable. I want to get rid of that denominator as quickly as I can. And so I can imagine that that they would choose a quicker default, or a quicker amortization period.
I can understand why as part of this invitation to comment, if the board were to add a project and we were to say we only want to improve the impairment only, I can understand why private companies would say don't take away the option I have today. But if we were to move down a path to say we want to require amortization for public companies, would it be fair to believe that the private companies would want us to reconsider how to amortize goodwill? And if not, what would be the basis in a decision-making framework to have a difference in an amortization cap? So right now the cap is 10 years for private companies, is that right? If we were to make it 15 for publics versus 5, would there be any basis to have a difference between public and private? Because I know earlier you said don't touch the private company alternative, but if we have a requirement for public companies to amortize goodwill, shouldn't we think about aligning that? And if so, that alignment could be, as Michael said, cap at 5. One board member believes that.
Would you still allow for the earlier?
Huh?
Would you still allow for a shorter
Oh, yeah,
period?
cap, yeah, always. But others would say, so I don't just...
Jim, do you have?
Just wondering if folks have seen, and if you haven't, that's fine too, but whether or not public or private companies have been hesitant to adopt goodwill amortization if they have, at least in their potential future, a public exit. Tim thinks yes. And so to me, that's one indication of maybe we at least ought to think about this for public. And I wonder if there's also on the other side those that are private, a whole host of reasons you might not want to go public, but it seems like, and we hear more and more, people are delaying longer and longer going public. I suspect this wouldn't be the only reason you might delay, but I worry that things like, well, I get harder accounting once I go public is just one more incentive not to go public. Probably a lot of reasons why. And to me, this is sort of an artificial one, because I happen to believe that the goodwill you acquired is wasting. We just couldn't figure out the period, so we said pretend like you could capture that through impairment. We know you can't, because it gets masked. We know it gets in the wrong period, and we know investors, by and large, ignore that number and back it out in their analysis. They tell us that they already had figured out that the business was going south before any accounting impairment, at least by and large. Perhaps the ones that happened early on, which presumably would have happened irrespective of amortization, signal something, but the ones that are late don't tell people anything. So I wonder But I voted against the alternative in the first place because I thought it should apply both to public and private, not because I disagreed with where the PCC was.
Jim, just on, kind of want to follow up. We say that impairments aren't being used. Are they using the amortization periods? Is that informative? Whether management chooses 5 years or 20 years? Do they, I mean, we say it's indefinite because we don't know, but.
Gary will tell you no, Hal will tell you yes.
Yeah.
Here's how I think about that. You know, private companies probably don't care about the amortization period because the readers, you know, the bankers don't care about it. If you went to a public company and you did an amortization period of 10 years, if you were to say that the amortization period was 5, you'd be implying that the deal was less valuable. So therefore, for public companies, if you give a 10-year period, most companies would do 10, and there'd be no other reason to do less because analysts don't care about the number. You know, if you look at intangible asset amortization, everybody backs it out. Nobody cares about it. You have issues like customer lists. If you go back and read 141, 142, they were talking about magazine subscription lists. Now we have customer relationships capitalized on a balance sheet. And my period at Lazard, I never heard one person talk about that. For a good reason, it's got no relevance. So, yeah, this issue is kind of, the way I think about it, you have fair value business combination accounting in a historical cost, world, ocean. So essentially, it's just a difficult thing, and I think on either side of amortization, you can say, I should do it, and you shouldn't, and I probably agree with both sides. But to me, putting something else in the income statement that I know investors are going to back out, why does it make sense?
I guess we haven't really answered your question, Russ, if you were asking the question of us as far as would it be problematic if the public companies had a different time period, a different cap than private? I don't think so. But that's, again, in my little world, it wouldn't matter. I advocated in the last meeting, go to 15, because that's what the IRS uses. And then my good friend Jeff Bryan, who was listening in on the call, emailed me about the rationale for the 10, and I get that. But I don't think it would be that problematic if there was a difference other than the description of why there is that difference. And could the private companies who may want to go instead of 10 years, my God, Rick, why are we doing 10? Can't we do the 5 to get it off the books? I think that would be the problematic part of it, is describing why the difference, which there probably is good rationale for. But I could see that being an issue.
The reason I bring it up is we have the framework that's supposed to help us decide when there's differences. It worked really well, I think, in the original difference. But if the board were to drive the public companies to the same philosophy, meaning amortization, is there still a basis for a difference? And what I'd hate to say is the difference exists because of the original scope being just public and not both. And that's why I was getting at. So I can completely understand the advice of don't touch the philosophy of amortization, but it's okay to touch the details of amortization. But I'm not sure if the PCC's advice is don't touch it. That can be very difficult as we get through the decision-making framework if we were to go to amortization. That's all I'm asking.
The one reason I'd raised my flag earlier, and I just wanted to ask the question, and I apologize if it's kind of a simplistic question, but that's me. Has there been ever discussion amongst the board when you talked about the amortization and the amortization periods of going away from straight line and maybe going more to a declining balance or something like that? I mean, in reading the document, it reminded me some of the arguments that folks have, and I understand it even as I've just talked about with some of my clients, that we understand that goodwill does not have an infinite life, that it does have a lifespan, and typically that lifespan is used up more in the early part of my tenure of buying David's business than at the end, because then it becomes more my goodwill than his. And should there be some rationale for allowing, from an accounting standpoint, the systematic write-off of that much more quickly at the beginning than over time? Because I get the arguments here. Now, granted, I still have my deferred tax issue that I've whined about with the IRS in past meetings, but has there been any discussion about that?
I don't think there's been any explicit discussions. There have been discussions about those that want to amortize. It's a debate about what is goodwill and what does the operational aspect of the amortization tell you. So some would say it's kind of what Mike was talking about. Others would say we ought to amortize it because it's a cheaper way to get it off your books. And so if you were to take that approach, doing some form of acceleration and having to prove why the acceleration could mitigate some of the views that it's just a cheaper way to get it off your books than impairment. And I think we just don't have an agreement amongst those that want to amortize as to why amortization is better. Some say it's just cheaper, simpler, let's do it. Others say, no, it gives real value. And that's why I don't think that we've been able to coalesce around how to amortize. Fair? I mean, I'm kind of the non-amortization, so it's easy for me to say that. But.
Yeah, I don't think we've talked explicitly about things like double declining balance or something like that. Some on the board would say it goes away very quickly, 2 to 3 years. I think others maybe more, precise or complicated. And I don't mean that in a pejorative way, but in their methodology, probably. Look, I don't think we're going to do a lot better than 10 years and let management justify it because the accounting profession has debated this for 100. I think if we could find out the way in which goodwill disappeared, we'd already be doing that. And so 10 years is good enough. 15 is fine with me as well. You just pick a number and do it.
Yeah, and I think you were next.
Thank you. I just want to make an observation on goodwill, particularly for our public companies. So ever since the issuance of all the simplification stuff, we really don't have any issues with assessing impairments of goodwill for our public companies. We actually, a lot of our clients, the fact that if they are indications for impairment, that's also calling to question of any going concerns. So that's like red flags goes up if the business is really not doing well. I think impairment will be the first step to sort of indicate it to the investor, the reader of the financial statements. But we do struggle with other intangible assets, customer relationship and non-compete, for example. The fact that the company, as well as their valuation specialist, spend a significant amount of time trying to carve out individual intangible, as well as try to assign a useful life to it, I think that's where majority of our time spent on business combination.
Yeah.
So Jan, do you see those as unrelated or related in the following sense? So, if we were to say, well, you don't have to separate those out because of the cost involved with separating some of those intangibles out, and maybe the nebulous information that's actually being provided from doing that, but then they'll get subsumed in goodwill, which is then not amortized, and it's just going to sit there. So do you view what's in and out of goodwill, that decision, to be connected to the decision about whether or not to amortize goodwill, or would you be fine with just put more stuff in there and let's just let it sit there until the company goes bankrupt practically, and then we'll write it off?
I don't think they're entirely related. And it could be just the standards is defined a while ago, and in order to fit the business model and to the accounting term that's defined as customer relationship and so on and so forth. So that's where we spend a lot of the time with the clients and the valuation firm, try to classify whether we're falling into the right bucket per se. But I also hear goodwill is just one number that sits on, it's a sink cost. So, but it's a number, it indicates whether the business you bought actually has some values or not. I would just think out loud, if everybody discounted the goodwill, then if we mandate the public company to have to amortize it, they will have to back it out every single quarter for the next 10 years. Instead of it's a red flag issue that raised for any going concern issue, that's a one-time indication. So I'm trying to balance which information are more useful or relevant, to what extent. I haven't really sorted that out in my mind, so.
Def?
Rick, we bankers use a very accelerated approach to goodwill. We just write it off.
Anything else? Russ, did you get your answer pretty much? Yeah, I mean, I think in the details, as long as you don't take it away and give us the flexibility to do less, I wouldn't have a problem if that changed.
Second. If there was anyone interested in being part of that round table, we'd be happy to have you. Thanks.
Jeff was here, he just stepped out, but you'll see his involvement.
Yeah. Okay, we are now down to our last topic, which is topic 8, our PCC issue number 2018-01, which we have been discussing now for the last several meetings, which is the practical expedient for measurement of grant date fair value equity classified share-based payments. And in your materials, the staff prepared a nice memo for us to kind of recap everything that we have done in this topic for the last many years, I guess, maybe since 2013 when PCC first started talking about this topic. So I'll just turn it over to Chris and team, and y'all can give a high-level kind of summary of the memo, and then we'll open it up for discussion.
Sure. Thank you. Yeah, so to your point, what we did in the memo was to provide the summary of the outreach that is done on share-based comp since 2013 by the PCC and the board. In June, we talked about outreach that was performed with 6 firms, trying to obtain some information on the pervasiveness of the issue, how the awards are audited, and also if a proposed practical expedient whereby current price current price would be assumed to be the same as strike price with certain guardrails around that. We found broadly that the feedback was mixed. We then agreed to do prepare outreach, but not in the same form as the firms. We did it through a survey whereby we sent it to a significant number of pre-pairs. The response rate that we got back was not as good as we hoped. Didn't really provide us with much. We also the PCC and the board also got some feedback from the NVCA conference. But what we're here to do is to talk about the feedback that we've received to date, and to determine what the next steps are for us in regards to this project. I'll stop there.
So we've had lots of discussions on this topic, and we had, we've had discussions with the board in the last, I think, 2 or 3 meetings. I guess certainly since the December meeting about this topic, and we would really like to come to some sort of resolution on what the next steps are on the project, and also to hear from board members if you have thoughts, comments of items that we haven't talked about. We'd be happy to talk about those today and see if we can come to some sort of mutual understanding of where the PCC is and where the board would lie as well. So I'll just open it up for discussion. No one wants to go first. Jeremy?
So I've been a vocal supporter of this. To echo what Chris was saying, I think the feedback from the preparer community was very low, but based on, I'll just say, my own personal outreach to plenty of clients that have this issue, the feedback was positive. What I would like to see as far as next steps, based on my understanding of how the standard setting works, is to consider issuing an invitation to comment on this so that we have broader feedback from the community.
So I think, Shane, we talked about whether it was an exposure draft, invitation to comment, discussion paper. Maybe you could help us understand what the differences, obviously we know what an ED is, but differences are.
Sure. So obviously the chair of the board has to approve the issuance of a discussion paper or an invitation to comment. But the invitation to comment, much like the goodwill invitation to comment, is more of a staff-driven document. It can have ideas in there for what the perceived problem is. Do we think that there's a problem? What the perceived costs are? Do we think that this would, what are some of the solutions that could be provided? Would that address the issue of costs? Also address objective? Is the objective to lower costs? What exactly is it that we're trying to get across, and ask a series of questions, and then those questions could then inform the staff of a broader set of feedback that we could go out to, as opposed to just what we've been doing. So that's in general what we would do. The discussion paper is relatively the same type of a document.
Discussion paper is a broader term. Invitation to comment and preliminary views are 2 types. Invitation to comment is, here you go, no views. Preliminary views is actually, and then a preliminary view. The PCC, it was not contemplated that the PCC would do this. So it's not clear, and we could figure it out, but like in a preliminary views, it's not clear would the board need to endorse that or not. I guess one perspective, here's how I think about these projects, just so you asked him. So ultimately what a board member has to do, and I think what a PCC member has to do, is you need to judge whether or not you think the benefits justify the cost. Benefits being higher quality information, more transparent information, and cost being what I've always viewed as borne by the preparer, because it is the investor that indirectly bears the cost of the preparer. And I think about audit fee when I think about cost to prepare. I do not think about auditor internal costs. I think about auditor fee. So in this, when I look at it, I don't actually think you're providing a benefit. I don't think this is designed to provide more transparent information to investors. I think that's fine. To me, it's about, is there a cost reduction by the preparer, either their internal cost or their audit fee? And I'd be interested in understanding how individual PCC members, based on the outreach, view that. Because I am hearing there is not a reduction in the cost to the preparer. But if that's true, I don't know why you're getting the feedback you're getting. Because you're saying your clients want it. So where would your clients be seeing the reduction in their cost? That's what I'm just not seeing from the the research and the outreach?
The reduction in the cost is twofold, and I've mentioned this before in meetings, where on the preparer's side, it's going to be partly now, because we're almost uncoupling the fair value concepts from this grant date fair value, so that the auditors and the preparers aren't so hung up on trying to make this a perfect fair value measurement. So there's less cost there on the preparation side. Now that may involve that they don't necessarily need to, that they can start using other means to satisfy the requirements of 409A in the tax code. They can start preparing their own internal analysis because they don't have to worry as much about the auditor. Now on the auditor side, what we've heard from the outreach is they're going to look at it and say, okay, does this qualify for the expedient? And they go, so I totally understand the auditor outreach saying, we're not going to get to a point where it's zero cost and it's going to reduce our audit fees. They're going to say, but they will say, okay, great. After that initial determination that does qualify for the practical expedient, then we have less audit work to do.
So is it fair to say, like, if we were to make this practical expedient to say, your exercise in determining whether or not the intrinsic value exists on day one, the measurement philosophy is the same as what is in 409A?
Say that again.
Okay, so what this is saying is just assume no intrinsic value, unless anything gives you the attention otherwise. If we were to change the practice, so right now the fair value measurement is an exit notion. If we were to change that as a practical expedient to say it is the same as what's articulated in section 409A, would that save cost?
Meaning the company has to do no more for accounting purposes than it's already required by law to do for 409A. So that would be the expedient.
Right.
This doesn't say that.
Right.
This says do whatever you do.
So what I hear you saying is they've got to do the 409A for tax purposes, and now they have to do an exit notion for books purposes. Why not just rely on the tax purpose? To me, that would be a way to save cost to the preparer, would it? Okay. Is that the substance of what you're trying to articulate here?
I think so.
I think it was. We were just trying to avoid tying it to a tax code that could change. Then you'd have to come back and change the practical expedient, but
this my concern has been this ties it to nothing.
Yes, this ties it to whatever.
So we could tie it to something that isn't proposed to change, actually getting embedded in other spots, and then risk that it does change and have to change it. And that's been my concern, because today it says, sort of do whatever, including you could do nothing as long as you haven't had any evidence. I'm not suggesting that's what people will do, but that at least has some rigor.
And I wouldn't tie it to what I'd say is the underlying measurement philosophy is the same as what's ever articulated in 409A. And then the basis would be it's the same as 409A, and you wouldn't be requiring a separate valuation for book. Mm-hmm. That's what I think your substance is. I think the way this is worded, I've always been frustrated by the assume. I don't know how an auditor ever, with your requirement to be professionally skeptical, I don't know how it works to say, I'm no longer professional skeptical. But there's ways to work around that. I'm just trying to understand, is that the substance of what you're trying to...
I think it was the substance of what we were trying to say. We were trying to word it where it would not be tied to something that could change. And that's it. That's it. Yes. Stop the fair value under A20. Right. Tim.
So I guess I would respectfully disagree with Jim's characterization that this practical expedient ties it to nothing, because the conditions that need to be satisfied in the way it's laid out today would require that the company has not taken a position for tax purposes that is inconsistent with this position. So effectively, this is tying it to the 409A valuation, such that if you had a 409A valuation and it was applicable, that you couldn't be inconsistent with that, which is tying it to that.
I'd tie it directly.
But Tim, if you didn't do so, if you had done the 409A, it'd be the same as if we just wrote the 409A. But if you didn't do the 409A, what's it tied to?
Well, again, there are other guardrails that are specified here, which are that the terms of the plan have to require, not everybody's going to get a 409A valuation. Not everybody, and so the challenges as we originally went through this, it was, if you tie it to the 409A valuation, then every 409A valuation is going to be done to the same amount of rigor as the current gap valuation, and you're back into the same thing that you don't end up with any net cost savings. If I may, let me just address questions that Russ you sort of alluded to. One is, is there cost savings? The feedback we got from practitioners is, a little bit inconsistent in that they said over the entire system there's not really any cost savings, but many of them said that they would expect a lot of their clients to adopt this. That's inconsistent. The idea that if it's not cost savings, that they would still go for it. You're going to talk to TIC later, and they can speak for themselves on this, but we didn't hear yesterday any people from TIC saying, we don't support this. In fact, we heard quite the contrary. So, and it was a lot of the same concept. Something like this would save our clients money, and a lot of them would adopt it. And there's question about pervasiveness, and it seems to me that this is a topic where it matters when it matters, and to generalize across the whole universe of private companies is not necessarily going to get you the most specific answer. There is a subset of companies that I would argue that this is much more likely to impact more materially. And it, sort of quantifying the cost, it seems to me that this is analogous to quantifying preventive medicine, right? Doctors are going to do a whole mess more tests and all the rest of that if they know that they've got these liabilities associated, malpractice and all the rest of that. We're trying to reduce the malpractice risk associated with this. We're trying to bring down the cost of preventive medicine in the accounting function with an expedient like this.
I think all I'm trying to say is I understand the desire for an expedient. I just don't understand why. To me, it'd be a lot simpler, a lot more understandable, is if you tied the measurement philosophy underlying stock to what is in 409A, and not this one that just says it's what management says it is unless you find evidence that says it's not. So I think we're debating about how to word the practical expedient. So if Jeremy's view is correct, that 99 times out of 100, they're just going to rely on the 409A valuation, why don't we just say rely on the 409A valuation? To me, it just seems a lot easier, a lot more understandable than this. Management just tells you it's right, and you've had to find evidence to the contrary. From an auditor standpoint, if this was there, what would you do?
If this is in place now, I'd be working with my clients that have stock options, and we'd be looking at exploring how we can satisfy the 409A requirements without the valuation. So 409A allows all those other methodologies, but because right now we're stuck in, as Candy pointed out, this 820 world where we got to beat up the fair value.
So if the choice is this, or the underlying measurement philosophy is the same language as is what's in 409A, which one is easier to do? I'm not arguing against a practical speed.
Sure.
I'm arguing against.
Well, that one's going to be easier. What's currently worded right now, saying, okay, run with whatever exercise price is fair value in your time, assuming you meet there's absent those other criteria.
So what's in paragraph 28 would be easier than doing the 409A? Because if they have a 409A, you've got to evaluate the 409A.
That's right. That's right. It's just
28.
Okay. Straw man wording. Rick, do you want to chime in on how you would audit or no?
No, I don't. I'll let Jeremy fight this one, but no, that's a good question. I think If there's a 409A in place, yeah, we're going to look at that. I think every auditor that we talked to said that if they have that in place, they're going to look at it. They usually might get their evaluators involved to take a look at methodologies, that type of thing, just to ascertain was it done appropriately and so on, and then moving on with life. I mean, that's the gist of what they told us. So I think that would be a very simplistic way to go. I can't argue with that.
Did you have something else? Your plaque's been up, yes.
I did, but if we're on the track of making life simple, I don't want to derail us, because that's good. But the one thing where, Russ, you mentioned about the cost, and it's you didn't really get any input about, or it hasn't been indicative that there would be any cost savings. If we wanted to do just something more, because the outreach we did, frankly, wasn't very definitive, the last outreach. And I think there was probably some glitches in the system, whether it be on our contacts had glitches in their system, or somehow we did, because many of them apparently didn't get the survey. The ones that we targeted that said, yes, we want to participate in this, and we are involved in this, they didn't respond. And they had told us that they would respond. Well, they didn't get the survey.
So hold on. I want to correct the record on that, because they in fact did get the survey.
Whether it went to their junk mail, whatever.
There were 18 people that were targeted that the PCC gave us the names of 18 people, in addition to the other 1,000 that we sent out.
Which is, why did you get the 1,000?
But just let me finish.
Okay.
So of the 18 that the PCC gave us, everybody with the exception of one got the email. 12 of the 18 opened the email and didn't fill out the survey. Only one email got kicked back. One of the 18. So this notion that nobody got the survey is simply not true.
Okay. Which is why I said it could be on their end, could be on ours. Obviously, it's on their end. Great.
And in fact, we followed up with all those 18, with all of them, and said, we're going to extend the survey and make sure you look for it.
So they would have gotten 2 emails.
That's right.
So I'll get back with my contact who said they didn't receive any. Maybe it's in junk. I should have them look for 2 emails in their junk mail on why they didn't respond, right? Is that what you're telling me, Shane?
That's right.
So if that's the case, then let me do that. If we think that is valuable information with those 18 people who told us that they would respond to that survey, and then now I would go back to them and say, well, in this case, Aaron, why didn't you respond to the survey? That would be good information for me. If that's the issue, then fine, we're done. If the issue is, no, I'd still love to participate, which is what she told me, and I'll gladly fill out the survey, it's in my junk, do we want to have further contact between us to those 18 that said they would participate and find out what they say? I mean, is that something we want to do?
We would be happy to talk to those 18. But the fact that they didn't fill out the survey, I am skeptical as to whether they will actually get on the phone and talk to us if they won't take the time to actually fill out a survey.
I think they'd
And
more
if they
inclined to talk
would,
to
we
you than fill out
probably
a
will
half-hour
need
survey.
your assistance to get to those contacts to have them call us, because they're not responsive.
But Rick's point, I think, is a valid point that we should all consider is the last meeting, we all said we needed more prepare outreach. For whatever reason, getting 3 out of 1,000 or 4 out of 1,000, I asked the academic, the PhD, sorry, I didn't call Mike, but she said it's not statistically valid. I think we'd all agree with that.
That's correct.
We should ask ourselves, do we want to, what do we want to do to get that prepare outreach? To me, not requiring 2 valuations is a cost reduction. I don't need Frank and his peers to tell me that. Having to audit 1 valuation and not 2 is a reduction in cost. I'm not sure in the straw man that you actually don't end up with 2 separate valuations. A and B would imply that there may be 2 separate valuations. The fact that, and so in other words, to me, the easier way to deal with this is to get rid of and be explicit. You no longer have to do the exit notion. The measurement philosophy is not exit, it's this. That would change the system and that would reduce cost. That's not what I read your straw man. That may be your intent, and if that's your intent, there's a lot easier way to write it. That's all I'm saying. So logic tell you, requirement to do one valuation, it's going to be cheaper than two. It's going to be cheaper to audit.
Okay. Jim has had his plaque up for a while. Do you have response?
That was a similar spot one, interested in we did hear, at least from the input that we did, the phone, not the other discussion, that by and large people did not think it would reduce the effort by preparers. I think what we heard is by and large preparers would not change their behavior, at least as it relates to 409A, and that many were using the same methodologies already for stock comp with some adjustment. And so I'd like to understand sort of the basis for cost reduction, and if it is a reduction in audit fees, I think that's great. We ought to be transparent about this. Preparer behavior won't necessarily change, but audit fees are expected to go down, and so that would be helpful to know. If neither is going to change, then I would not be supportive of. If this doesn't reduce preparer cost or audit cost, I would not be supportive of moving forward. I like Russ, think that tying it more directly to 409A could clarify that is an acceptable practice. I've been a little, and Tim, I take your point that it doesn't say do nothing. That was pejorative on my part. But I am skeptical about it. You said, well, some may choose not to do anything for 409A or not to do a 409A evaluation. I suspect if a company didn't do that, the auditor would still likely come in and say, I need all of the information that you have for 409A purposes, because if anything is contrary to what I've done here, and if the company says, well, I have no basis for 409A, I suspect that puts the system into a little bit of a do loop of you got no basis for your tax assertion. I get that the tax assertion primarily has a penalty on the individual, but it also imposes penalties on the company, particularly individually for each award there's penalties, and if it's done without support, the penalty's higher. So I suspect that puts the system into a little loop, and so I've just been more supportive of take the words in 409A and say that is an approach that's acceptable for GAAP. I've said that from the beginning. I personally would take that and move on. But this form is more troubling to me. The form it's in currently.
And just to answer a couple of points you made, Jim. So I think my client base is probably in the minority compared to everyone else that I've talked to. But literally every client that I have that has share-based compensation goes outside and gets an external valuation. I don't have one client that does it internally. So for at least my client base, this could potentially save them money, that they will not have to get an external valuation. They could get something a little less with a 409A. I would look at it, yes. And maybe also we are in the minority, but I don't think so, based on a couple comments that were made at the meeting with TIC yesterday, is we have to make sure that it's not, that it's, if it's fair value, that it's at least reasonable, and that if that input is not materially out of line, right, to know it's immaterial. So we do work. I get a valuation guy that goes through and he writes a memo, and at the end of every memo he says this is done in accordance with 820 at the end of every memo. So every client I have gets a valuation. Every client I have, I get my valuation guy looking at it to tell me that it's all good. So for that subset of people, it will definitely save money. And I would just bet that I'm not the only person out there that has that base of clients.
Yeah, and do we know, and this would be helpful to me, is because if you get an external valuation for 409A, you have safe harbor. If you do it internally, you don't. And so it actually changes the IRS's position vis-a-vis the assertion. The IRS has to definitively prove wrong the external valuation. They don't have to do that internally. And so are they doing external valuation for 409A for the tax safe harbor? They don't know. I mean, those are the things that I'd be interested in, is will this change management behavior?
And have you asked them, if we were to do this, or if we were to say your measurement philosophy is the same as 409A, would they still get the valuation? And if so, would the valuation be cheaper?
And I have not asked them. It's possible, but my audit procedures would be less.
Okay, so then your audit cost would be less.
Yes.
To Jim, would that mean your audit fee would be less?
Probably, yes.
Okay, so the reason that's a good thing is that would reduce cost, right? And so, so we're in alignment of doing something. The debate is about comparing just wording it based on the valuation philosophy in 409A versus this.
So I just want you to help me understand how the audit procedures will change in the following sense. So when the Black-Scholes option pricing model is run, right, there's 5 inputs, and each one is put into the model individually: stock price, exercise price, so forth. So what this practical expedient says is that you can assume that the stock price is equal to the exercise price, right? So that gives me the stock price number. But the exercise price is still something that presumably you have to audit, because the exercise price, if it's $20, is going to end up giving a much different value for the option than if the exercise price is $3. So what work would you still be doing around establishing the magnitude of the exercise price itself?
Well, I wouldn't have to have a valuation specialist who to look at the valuation, because it wouldn't be presumably under 820.
No. I'm asking to come up with the amount of the compensation expense.
Right.
One of the inputs is exercise price.
Right.
So what are you going to do to validate the exercise price?
I'm going to look at what management obtained to set the exercise price. They did something, right? They did something.
Right.
So I'm going to look at that and see if that looks reasonable, and then I'm done.
So I think the exercise price, literally the way it works today is that you read the agreement. There's not separate auditing. It's just exercise price. The stock price is what gets audited, the underlying.
Right, but that's what I mean. It's like if you're shifting the focus from the stock price to the exercise price, now the exercise price becomes the thing that has to be audited, and the exercise price by definition is the market value of the stock at a point in time. So it would seem.
I think they're saying that the exercise price auditing procedures wouldn't change. You'd read the agreement and presume the two are equal.
So the underlying stock price. So I think Christine's assuming the exercise price and the underlying stock price are the same. So you need to audit. So the exercise price is whatever you gave to the employee. You're trying to then determine the intrinsic value. In order to determine that, you have to audit the underlying stock price.
Right.
Right. Okay, so if we were to do either what's in 28, paragraph 28, or just rely on the tax, okay? So if your client had an independent valuation for 409A, this would say, assume it's right. Would you get your valuation professional involved to look and so it's just the company has taken a position, so you just need to see what they filed? You don't have to determine, I mean, even in a...
Let's just say there was a mathematical error in that. And I'm trying to just think this through. I'm not saying that there would be, but mathematical error in the formula. Auditor would not need to look at the formulas derived, because you would just say they didn't take that position. Or you looked and said that the underlying assumptions in the 409A don't seem reasonable at all. But you don't need to audit that, because you could look at it and say, look, these aren't reasonable, but they didn't take a different position for tax purposes.
Yeah.
Not a fair value calculation.
Yeah, I got you. You wouldn't need to audit the tax position. So they could have, and again, I'm not saying they would do this, but they could have unreasonable assumptions, and that would be okay.
Okay. So then my other question was probably more for Frank. And that is that it seems to me that exercise price matters, right? Because what you're setting is the amount that an employee, if these are going to employees, are going to have to pay for these shares in the future. I mean, you're establishing a purchase price for a share at some point in the future, and that has real cash flow implications, right? If I say exercise price is $20 versus exercise price is $10, that's going to matter. It's going to matter to the employee, and it's also going to matter to the company. So it would seem to me that this is not just an assumption that we're throwing out any number just for purposes of running a model for accounting purposes. I mean, it seems like there's a real economic implication of this number once it's established. So that's why I struggle with understanding really where the beef is in terms of the huge or significant cost savings that's going to come, because it would seem to me that a preparer is still going to want to get that number in the ballpark right.
Yeah, it's true. I mean, there's a lot of reasons why you want to get that right, including what are you giving away from a dilution standpoint, for example. So I think you're right.
So in the spirit of providing some feedback on what my individual views are, and not to be redundant, but as I think about this, I continue to go back to the PCDMF. We don't have that conversation enough. And for those that want to refer to it, I'm looking at paragraph 1.3, which says that if the guidance provides relevant information, and we've established that at least, perhaps there's mixed views on relevance, but we've established relevance, that the board and the PCC should consider whether the use of one or more practical expedients could satisfy the needs of users of private company financial statements while reducing the cost and complexity for preparers of those financial statements. And so, as I think about that paragraph, and then I go back to the memo on paragraph 28, which actually has the expedient that we vetted through outreach, I still, much like some of the others that have expressed their concerns, I still haven't felt a compelling argument that we have reduced the cost, at least based on what I'm reading in paragraph 28. I too have similar thoughts to what Christine has, and my read of this would, at least from my perspective, give the concern that you have to provide, because it doesn't really have any hook, if you will, other than A, B, and C, which you may or may not have, that puts more pressure on the process to develop the share price. That's the way I feel when I read this, because otherwise, what we've learned in the 409A, and I like the idea of the hook of 409A, but I think what we also learned through earlier outreach is that not every company does that, and some do it after the fact, and some do it. So then what kind of pressure does that put on there? Well, okay, so then maybe we're more reliant on the process to make sure that it is, at the money. And then after we had some of the conversations with Tick yesterday, and I really realized it wasn't a private session, but we did hear that perhaps there's a lot of, what was the word, online valuations that perhaps weren't as robust to get the 409A valuation, and that gives me a little bit of nervousness. But then my other thought is also around pervasiveness, from the perspective of, are we really doing an alternative that is going to be able to be utilized by a lot of different companies? And we've talked about the process that companies go through. Frank certainly has shared his views in this meeting, and in previous meetings we've heard from some others about that. And even at the TIC meeting yesterday, I think the TIC, while they were supportive of an expedient, they certainly suggested that there may be other areas in GAP where we could have more impact. And the analogy that was used is if there's 100 companies, we might get 2 that actually are able to take up the expedient, whereas if we were to focus on expedients on some of the other suggestions that we'll talk about with TIC later on, say, for example, leases, 100 companies would be able to get that. And so while I'm not comparing apples to oranges with leases or share-based comp, I do wonder about some of the other areas that have been put to the sidelines to focus on this effort that could have more bang for the buck, which is in disclosure, profits, interest. So that's at least where I am at the moment.
Tim?
So I think, as you know, I'm a proponent of the language that's in paragraph 28. But I'm a reasonable guy, and I'm not necessarily convinced that I'm always right, most of the time. But, I think we came up with the language in paragraph 28 in the first quarter, and there were concerns that were expressed about some of the same concerns that Sue and Christine have articulated. And we undertook to do some outreach to sort of understand some of the concerns a little bit better. I would say, the outreach itself, even in its best scenario, was going to be too high level to get down to some of the granularity that relates specifically to issues that have been expressed. So if we think about the best way forward, I can get behind and be very comfortable with the idea of doing an invitation to comment kind of document, but that sort of seems to me like yet more outreach that may or may not get to where we want to get to. If I'm hearing Russ and Jim in particular, and some elements of Sue's comments, if I'm hearing that well enough, that maybe there could be support for a practical expedient that specifically ties it to 409A, maybe we should just move forward with an ED that ties it to 409A, and then see where we get to, see what feedback comes out of that, and say, okay, here's a suggestion. Where do we go forward? It didn't seem to me like, to me, paragraph 28 is sort of the perfect, but let's not let the perfect be the enemy of the good. And maybe, some construct of tying things to 409A could be good enough. And maybe we would get good response to that. So, if that's on offer, I'll take that door.
Okay. Got a lot to cover here. Bear with me. First, I got to say, I love that Christine started with a "where's the beef" reference. I feel old because I know what that means. All right. So, just to clear the air, currently what's going on, as I see it in my practice, is clients are taking a double dip on the valuation. They engage an external appraiser to come in, provide a valuation that satisfies 409A requirements, and then knowing that it may never be needed for tax examinations by any taxing authority. But they do know that the auditors are going to come in and ask for it. So rather than them availing themselves of what's in 409A and doing their internal analysis and then having the auditor say it's not good enough, they just go ahead and engage an external appraiser to come in and provide that valuation for 409A. Then from our side, we'll have our own valuation specialist look at the client's valuation specialist work and determine whether it's appropriate for GAAP. Now, what I would love to see this go towards is that there's no external valuation required, that we take that cost out of the system, and it reduces costs on both sides. Now, I can't speak to whether or not auditors are going to reduce their fees, Russ, because that's a whole separate understanding. But from all we'd be looking for is that whether it's within a reasonable range. Now, what we've talked about in prior meetings is that, by and large, the outreach that's come about has said that measurement is irrelevant. They care about recognition, but not the dollar amounts. Everyone understands, as Tim's explained many times, that this is an assumption baked on top of assumptions, right? That it's all these estimates that are baking up, and everyone knows that the number ultimately is going to be totally different than what's determined as grant date fair value. So right now, we're in the system where we're trying to, both the preparer and the practitioner, go in and say, okay, is the number correct? Quantitatively, let's determine, is that number correct? Not is it high, is it too low? Is it just right? And if it's not, how far out of bounds is it? And can we live with that material from a materiality perspective? What we're talking about is changing it fundamentally in two ways. One, saying, instead of is the number right, is it compensatory? Is it in the money? If it's not in the money, we don't care. Just prove to us it's not in the money, and that's where it links up to the tax code, section 409A. But this practical expedient goes further and says, you know what, we're done looking at the quantitative calculations that go under that underpin this thing and making sure that's right. We're going to start with a step zero, this qualitative analysis, and say, okay, from a qualitative standpoint, are we aware of anything that makes it unreasonable? Because we already know that when they determined the strike price, however they determined it, they had to make sure it was, or they were incentivized to make sure it was not compensatory. So we're already comfortable with that hook there on the tax side. What we're trying to do is alleviate the gap side of it and say, okay, great. Can we just get by with the step zero qualitative analysis and then move on? In between the combination of saying, well, a company could prepare something internally because the auditors aren't going to necessarily have to beat it up. Now, there's always going to be outliers where they may, but auditors hopefully can just be satisfied with the company doing an internal analysis that already meets 498 requirements. Then we're done. And we do that qualitative analysis and move on.
Frank, you get a valuation, right? What do you do?
For different reasons.
That's my point.
Right.
Jeremy's claiming the valuation is solely because of the auditors. I didn't hear that from preparers. So notice, what I heard you say is you want to save the cost because you think there's unnecessary costs in the system because somebody believes you need to get a third-party valuation. 820 doesn't say you need one. Board's never said you need one. And so that's what you're saying you want to get rid of. And I think you're saying the reason the valuation is because the range of estimates should be here and it's here, right? That's what you're trying to do, right? From a real management perspective, you're getting a valuation because why?
We've got buy-sell agreements, we've got operating agreements, repurchase agreements that we don't want to rely on something done internally.
Right. So he'll still bear that cost.
And like I said, this isn't going to be a one-size-fits-all solution, but it will. I would argue that Frank is a fantastic example of an outlier where he's viewing it from a totally appropriate perspective that most private companies I've worked with don't have. They view it as this is a compliance issue, and that's the reason I'm getting the 498 valuation. I'm doing the double dipping. Now, if I could figure out a way to sidestep this for GAAP purposes, then great. Maybe at some point later, if I'm audited by the IRS, great, I'll get the 498 at that point. But for GAAP purposes right now, I had to determine the exercise price, hopefully in accordance with 498, so that I'm not having a negative surprise later. And we can have for GAAP purposes, they could accept that.
I don't understand why can't they just do an exit notion and go, well, the last time the multiples, 12 times revenue, and this is the revenue number, is 12 times. Why do they feel they need the valuation if it's solely for GAAP purposes?
So that's when we did the auditor outreach, what I heard and was that they're not requiring an external valuation to be done. So if it's a new client that they've never had before, then they might want to have an external valuation done for the first time, or they might bring their own valuation experts in to sort of kick the tires and determine whether or not it was done appropriately. But what we generally heard was that for a lot of entities, these amounts are immaterial. So they do analytical procedures, make sure it seems like it's okay. If there's a difference, they take it to the error schedule, and they're done. If the amount is material, then they do a lot more work. So again, from all the outreach we've done, it just seems to me the preparers still want to get the number right because it has real economic implications, and that I didn't get the sense that there was mass over auditing that was being done in this area. When we ask entities, and I'll ask the question again in this room, how many times have you forced an entity to change their inputs? So how many times have you gone in and audited the numbers and said the exercise price is not equal to the stock price, so I'm going to make you change that, and it's a material error that goes to the financial statements? And when I've asked that question in the past, and when I asked that question on the phone, what I heard was rarely. So again, I don't see where all of these cost savings are going to come from.
But I need help here, because I think Christine said something exactly opposite of what you said and what you've said. Am I reading that right? You said you require evaluation, you require evaluation. She's saying other auditors don't require evaluation.
So we had this discussion yesterday at TIC, with TIC in the room, and there were quite a few members from TIC that expressed the view that most of their clients have internal valuations.
Right. I think I'm the outlier where 100% of my client base gets an external valuation, and I don't require it. They just get it.
Exactly.
And I use it.
Probably because they want it. Right, and they want it because they want to get the exercise price right, to Frank's point, right?
I would argue it's not to get the exercise price right. It's the double bang for the buck. They're going in there and saying, okay, I know I might hypothetically need this if I'm ever audited, but I know that my auditors are going to ask for something. So rather than me do my own internal analysis and the auditors go, it's not good enough, let me just shortcut the whole process.
So what you're telling me then is that they don't care what they're saying employees are going to have to pay for them, for those shares in the future. Is that true? Because if so, I'd love to work for a company like that. Can we have stock options where you'll let me just walk in and say, I think, rats. Okay, no, I just don't believe that. When companies offer stock options, they are making a contractual commitment with the counterparty as to what they're going to charge them in the future to buy shares. And I just can't believe for a second that they don't want to do some robust work around coming up with that number, because if they get it wrong, right, if they just pick a number and they don't have some understanding of what the value of the entity was at the time that they did that, then either the employee is going to be ticked off because they're going to find out that their options were worthless all along, or the other claimants are going to be ticked off because the company is now bound to sell shares significantly below.
And I agree with you, Christine. I think the difference here, or the distinction, is the precision of that number. And where the tax code stops at saying the precision is just limited to, is it in the money or not? A yes or no. Where GAAP is coming along saying, is the number right?
But the entity cares about the precision of the number as well, for real economic reasons beyond just accounting.
So let me articulate the riddle this way. So if Frank had a high degree of confidence his stock price was no more than $10. What I hear Jeremy and others saying is that GAAP would require you to determine, and you said the exercise price at 10, okay, and you had a high degree of confidence your stock price is worth no more than 10. For tax purposes, you'd be able to prove that it's not in the money. But for accounting purposes, you'd need to determine how much of that exercise price is in or out of the money. And that's what you're trying. I'm trying to understand what is the actual cost you're trying to save. So it doesn't sound like not doing evaluation is really what we're after. What you're trying to say is it is it is not in the money, and therefore you don't have to get the exact amount. That's your practical expedient, right? So the tax valuation would work for that, right? Yeah.
Jim, Pedro.
So I think Tim brought up a while ago whether he was reading right, the support, at least you read right mine. I would be supportive of mirroring language, which is in 409A, talks about fair value. It sounds more like it's not tied to an exit price notion, it's just fair value. There's multiple ways to do it. You can do it internally, you can do it external. It's not prescriptive. I would be supportive of that because I think it eliminates two valuations. I think by and large, even though everyone realizes it's an estimate, I think somehow people are coming up with a price for tax because it is used to then set the exercise price. Perhaps they're more confident that it's not it does require at least a one-directional precision. That is, it is not in the money. It doesn't require a directional precision the other way, but I think by and large, people are not trying to issue deep out of the money options either. So I think there's a natural behavior that says those two kind of work together to get to what the company believes is sort of the best spot in that, range of subjectivity that they're comfortable with. To go beyond that, and that's what I worry that this proposal could go beyond that, is say, if I had no basis for tax, I'm really willing to roll the dice. I could just assert that it's this. I'm not saying that's by and large what companies do, but I think it imposes no audit requirement on the auditor. And if that's what people want, I think that's a determination to be made by a different body. If there is a different threshold for auditing of stock options than other estimates, I don't think the FASB should be the one that says, we want this estimate to be unaudited. I think if that's what the profession is looking for and users are looking for, is to say they're comfortable with stock options being unaudited, that could be done by audit standard setters. And I don't want to get in the business of setting audit standards, but I am willing to make easier saying you only need to do it once for accounting.
Get myself straight up here. So I've listened to a lot of the conversations about this, and I can tell we're kind of just sharing, what have we absorbed, and I don't want to repeat. I want to be incremental to what the others have said and just kind of share what I think it is that I've absorbed. And what the feedback we've received from about preparer behavior, whether it's come directly from preparers or from practitioners that talk about preparers, is basically that management generally has a basis for a number that it has put into these agreements. I think what we're trying to do is acknowledge that it's an unobservable input unless there's been a recent transaction. It's an unobservable input in the private company environment, so we know that public companies have this a lot easier than private companies, and I'm all in agreement that this shouldn't be, this is less likely to be a material number in a private company environment than it is in a public company environment, and this seems to be one of the areas where it is harder to audit what fair value is on what presumably is going to be a less material number if we're looking at private companies in isolation compared to public companies. So I'm sympathetic to trying to do something to make that a little simpler. But it's interesting, and I know this isn't a perfect parallel, but when you think about even the conversation we had with rate reform and what does relief look like, and relief said, this is GAAP. For a period of time, you don't have to follow this part of GAAP. We want to make this easier. To me, I see a parallel. We want to make this easier, which is why I tend to think that what Russ is bringing out, if we can make it easier by making the practical expedient address, well, these are reasonable ways to think about fair value in this context because it is not easily observable. Then it does come down to, well, if the cost savings really should be on the side of, what the audit profession is doing, then I think other people have to evaluate, will that reduce the effort in that regard? But I'm not sure necessarily it's going to change management behavior in a lot of cases either way. But I could be supportive of something that has that kind of a parallel structure to what it is we've done in other areas of GAAP.
Okay. Any other comments from any PCC members or board members that haven't had the opportunity to speak?
Obviously had the opportunity, but where is the PCC? I mean, we've heard from some, but collectively as a group, do you have a proposal? Do you have sufficient support for a proposal?
Deb, do you want to?
Yeah, the answer to that, Jim, is I think we'd like to go forward. The question we're asking is where, how. My gosh, I think of the time that's been spent discussing this, I believe there are many of us who are saying it's time for us to move forward. I'm not sure whether it's this way or that way, and I recognize Russ has said this is a little bit unprecedented, but for goodness sakes, direction, please.
Right. And so when Shane threw out yesterday in our conversations that we might issue some sort of paper to gather more feedback, that was interesting to a lot of us. That's not where I had hoped we would be, but I think right now, and given this recent discussion that we had, where we better understand where the board is and what you would like to have something more, an anchor, I think that is something that, would be interesting to know if that would make a difference. I think also to understand if my client base is the only one that is different and that gets valuations, and I audit them because every audit program I have says audit fair value, audit fair value, audit fair value, and so I do. So, so maybe that we could do something like that that would ask those questions, and we could get some additional feedback. I would be supportive of that. I think based on the conversation we just had, that's almost where we are. I don't know, Tim, if you have any other thoughts.
I guess, Jim, if you're asking for, a show of hands or something like that, I mean, the two questions I have are, one, do we do an invitation to comment, or do we sort of encourage the board and the staff to try and move forward with a exposure draft which actually has a hook like Russ was describing, Jim was describing, that sort of ties it very closely to 409A. I would be in favor of the latter, and if that's not for some reason practicable, then let's get something else out.
Right. I mean, we would have to see the language, we would have to see the words. I mean, we haven't seen that yet to move forward with that.
Can I propose this?
Yes.
The staff can draft the language for what the 409A would look like. We could better understand. We have a meeting with the Auditing Issues Task Force tomorrow. With TIC today, Auditing Issues Task Force, we talked to TIC today about this. I'm sure it'll be in the discussion. But the Auditing Issues Task Force to talk about how they have this language. And one of the talking points was going to be, do you agree with what Jim had said, that this is basically, if your client doesn't have a valuation, what is your audit procedure? And what is the implications of that for this subjective estimate, other subjective estimates, versus the one where you say the measurement goes from exit value to a tax basis, for lack of better words. It seems to me that we could write that alternative. We could bring it back to the PCC. We could bring it back with the other things that need to be concluded upon to then see if you have the votes to move forward on an ED with that language or something else. But I don't know if an invitation to comment would actually provide you what you're looking for. It might. We've just never done an invitation to comment. How many did we get for the EITF one?
Not that many, but I can look.
Like less than 15?
Yeah,
Yeah, so we'd get less.
Yeah, and I would hate to spend another 6 months doing an invitation and comment on this and find out that we went from 4 out of 1,000 to 6. I mean,
Tim, to your point, if you think this doesn't go far enough, but it's a starting point, obviously EDs also ask questions, which I'm sure you envisioned, of, hey, here's one idea. Maybe some PCC members don't think this goes far enough, so here's some questions.
Right. Right.
Maybe all, I don't know.
And in the basis, you have a problem statement. The problem statement is you think there were unnecessary valuations being done. Will this solve that problem? Those are the kind of things that you state your problem statement. Here's your solution. You test that.
Y'all could do that.
Yeah, we can certainly do that. I mean, the invitation to comment idea was thrown out to bridge the gap. But if we're willing to move forward, if the PCC is willing to move forward with something with an anchor to sort of start off with and ask questions, then we can certainly write that up.
So the most efficient way to do it would be to ask the staff to write up the 409A language, send that to the PCC members, get some buy-in, and then they can start, there are certain questions like scope, transition, those kind of things. Questions you'd want, and then we can have a debate at the next meeting about what is the basis, what are the questions, what is the way in which to mark it so you can get the feedback.
But we can have something put together for the next meeting for you to react to. And say, do I want to add extra? Do I want to take away? Does
To
this
vote
make
on.
sense? Yeah.
Right.
Is that what you mean?
What's that?
To vote on.
Yeah.
If they choose to go.
Hopefully, we would have Beth and David here to vote as well. I have Beth's proxy, but we couldn't get in touch with David, so.
In response to your earlier question, we had 18 comment letters on the ITC we just did for EITF.
We had never done an EITF invitation to comment, so I was wondering how many we got. So 18's not.
Yes, so I would be in favor of that, to move this forward. How about
Just to
Chairman?
check, do we need a motion today to make any of this happen from the PCC?
Not if we're not going to officially vote on the ED, and I don't have words, so I can't vote on that. So I need to see the words first. Yeah.
So just so we're clear, what we're bringing back for the next meeting is not the full EED, or is it?
So what I think you would bring back would be the language for the 49A, and then the other questions you need answered to complete the ED. The blocking and tackling questions.
That's right.
And for those of the PCC haven't been through this, you'll see things like, do you want this to be prospective? If so, it's prospective for which share-based payments issued afterwards. Those kind of things that once the staff gets the direction, it's just a cut and paste into the document.
Is that clear? Okay. All right. Well, appreciate all the conversation and the participation by the PCC members and the board. I think we had, a good meeting. Hopefully, we provided the staff good input into a lot of projects other than this one, and maybe we have a clearer path to where we will solve on this. So, with that, we are a little bit past our deadline, so we'll go ahead and conclude our meeting and look forward to seeing everyone in December. Thank you.